Hello everyone, a very good evening to all. Welcome you all in this session in the YouTube channel of Oliveboard. I hope everything is okay. I'm audible and visible also. All right, so audibility is also fine. So let's start our marathon session, the last marathon session of paper ABFM. And tomorrow you will be having your exam. So one marathon we have already completed yesterday where we have discussed module A, B, and D. All right, today in this final marathon, we will revise module C and then we will be doing questions of all the modules all together, A, B, C, and D. And one request from you all, if you are new to this channel, please subscribe the channel. Watch the entire session. If you feel session was beneficial to you, then hit the like button and moreover share it with others as well. All right, so let's start with the session. So let's start first module C, that is all about corporate valuation. So corporate valuation C, in this module C again 6 units are there. And corporate valuation, mergers, acquisition, deal financing, these are the important chapter in our module C. Discounted cash flow valuation, other methods of non-discounted cash flow valuation, all this. So what is corporate valuation? Valuation means what? If the purchaser wants to purchase the target company, so how the purchaser will purchase? The purchaser will pay some amount, the buyer will pay some amount, then only, and how that amount is determined, that amount is determined with the help of valuation. So for that, for the reasonable amount, for the appropriate amount, that is what the buyers they do the valuation of the company. So valuation is done with the help of different approaches, with the help of different methods to find the actual value of the target company. So the valuer can use two approaches. One is the book value method and the second one is the market value. If the approacher is going for the book value, so book value means the value that is included in your balance sheet, like value on accounting statements. All the assets are included in the historical cost. They are added in the balance sheet according to the cost at what you have purchased previously 10 years back, 20 years back. So that is the value that is included in balance sheet minus depreciation. Why depreciation? Because depreciation, it's a non-cash item. You have to depreciate the machinery which you are using every year. Rate of change, it changes slowly and gradually, and formula is total assets minus liabilities upon outstanding shares. Market value means the value that is prevailing in the market. What is the value of the shares in the market? That is the open market price. In this, the buyers and sellers, they have the interaction, and how the market price is decided with the help of demand and supply, that is market fluctuation. So formula is current share price into the number of shares. Current share price means market price of the shares into the number of shares of the company. If number of shares of the company is 10,000 and market price is 100, so the share of the company will become, that is 1 lakh, 10 lakh. So this is current market price into number of shares. Now, next, this is important, the international valuation standard. Okay, in 105 taxonomy, so three different approaches are there for the valuation: market approach, cost approach, and income approach. Market approach, it's also known as this direct comparison approach. In market approach, we compare the competitor, we compare the target company with the competitor's company, or we find the multipliers of the competitor company, comparable company, and then those multipliers are used in order to find the actual valuation of the target company. Then cost approach is what? It is also known as the asset-based approach. In this, the fair market value of the asset is included, also known as the adjusted book value method. And income approach is what? In this income approach, I will ask to the seller that what are your future incomes? How much your company will going to generate in future? After 10 years, what is the income of your company? So that is income approach. Finds it calculates the present value of all the future income that is yet to receive. So that is why it is known as the discounted cash flow method, that is income approach. All right. Next is all about the cost approach. Cost approach, asset-based approach. So here the assets are adjusted according to the current market value. So all the assets, all the liabilities are adjusted according to the market value. So some adjustment is done in the book value, and then it is calculated in the fair value. All right, so what is the formula? Adjusted book value, that is the fair market value of assets minus all liabilities. Market approach is also known as direct comparison. In this, the target company, its similar type of company is found, the comparable companies are found, then those comparable company, the valuation is done, and that valuations, that multipliers will be used to find the actual valuation of target company. All right, so what are the comparable ratios? So EV, enterprise value upon sales, EV upon EBIT, then price to earning, that is MPS upon EPS, market price per share upon EPS, price to book value, that is market price per share upon book value per share, and price to sales means that is MPS upon sales value. So these are the different variables. These are the different comparables. And one most important thing, that the direct comparison, this is based on the principle of substitution. Principle of substitution, what it says, that the buyer will not going to pay more for an asset than the cost of the comparable asset. Like for example, if you are getting something in cheap price, so definitely you will buy that in the cheap price. Why you will going to pay more for the same item? So this is same like that. If you are getting anything at a low value, all the things are same. Like if you want to buy any flat, if you if you are getting the flat at a low value, then why you would going to pay more for the same type of flat? That is what the principle of substitution is. So common multiples used in direct comparison is EV upon sales, okay, EV upon EBIT, price to earning, that is MPS upon EPS, price to book value, MPS upon book value per share, and price to sales, that is MPS upon the sales value per share. Then next is the income approach. In income approach, we do the discounting of all the future values to find their value in the present term. So that is what time value of money is included in income approach. And this for income approach, for income approach, for doing the discounting, you need to know the discount rate. So discount rate is known as the risk rate, that is calculated. So either you will going to calculate with the CAIIB model, or you will going to calculate with the weighted average cost of capital. All right. So what are your expected future earnings in 1 to 10 years? What is the, and you will find you will calculate your future values in the present term. That is what the income approach is. So income approach is based on one of the main methods used to value business. It focuses on the company's ability to generate the future income. So what are the future incomes of the company? Now you will convert those future income into the present value. So value of company is determined with the present value of future income. Then adjusted book values, in this some adjustment are made. What adjustment? Because book value approach is what? It shows you all the value at the historical cost. But adjusted book value shows all the values that are according to the market value. So in this, adjusted book value refers to the value of a company after adjusting all the assets and liabilities to, so that they can reflect in their fair market value, not just what is recorded in the historical cost. Like you have bought any machinery, okay, you have bought machinery in the year 2000 worth rupees 10 lakh. Now the cost of that machinery in year 2026 is 7 lakh. So you will record this value, not this value. Suppose you have purchased any building, the cost of that building you have purchased in year 2000, let's take it 50 lakh. Now the cost of that building is 1.2 crore. So you will use this amount in today's term, not the amount that in which you what at what amount you have recorded in your books of account. So book value shown in financial statement is based on historical cost, what the company paid originally, but real value, it may be higher also, it may be lower also. If machinery you are calculating, the value will be lower in today's term. If you are calculating machinery, not machinery, building, land, so their value will be higher, because land and building value is appreciated and the machinery value is depreciated. So we adjust all the assets and liabilities to their current market value. So this is the chart. So there are liabilities and assets on one side. So in liabilities, we have share capital. These are all, the bold one are the one which is the bold. This shows you the total value. All right, this shows you the total value. So equity, we have then reserves and surplus, secured loans are there. In secured loans, the term loans are there, non-convertible debentures, unsecured loans, bank overdraft, intercorporate loans, current liabilities and provisions. So these are all the liability side. Whereas on the side, we have fixed assets, accumulated depreciation. So depreciation is deducted because we are finding that adjusted book values in this depreciation is not included. It is deducted in the fixed assets. Then current assets are there, cash and bank balance, receivables, inventory. So these are all current assets. Okay, when you are doing the valuation, what value you will take? The share capital investors claim approach. Why it is written investors claim approach? Because investors, these are the people, the shareholders, investors, these are the people, they put money for a long term in your business. They provide long term benefits in the company. So we will take only long term item, share capital, reserve and surplus, secured loans, unsecured loans, all will give you the benefit for the long term. Okay, so loans and unsecured loans, these are the debt, and share capital and reserves are what? These will give you the benefit. On the other hand, in asset, we have 116. And from the asset, what we will deduct all the current liabilities. Why? Because these are the obligation and these are for less than a year. So all the current liabilities will be deducted. So now we have got the adjusted book value approach by calculating in this way. All right. Then next is stock and debt approach. Stock and debt approach. Stock means what? What are the stocks? Stock means the shares. And debt means what? Debt means the loan. So it capital structure. See, capital structure is the composition of two elements. One is the equity. All right. One is the debt. So equity is what? Equity is the stock, that is the shareholders of the company, and debt is what? Debt is the loan. So stock and debt approach, it talks about the total worth of the company and how the total worth of the company is calculated by market value of the equity plus market value of the debt. So all the stock and debt are added, then you will get the total value of the total worth of the current market value of all the outstanding securities and debt. So these will be represented in their fair market value. Current market values, equity are these, shows the ownership in the company, and debt is what? Debt is the borrowed fund. So these are the all different types of approaches. Let's revise once. Income based approach, it talks about the discounting. It talks about what are the future earnings of the company, and those future earnings will be calculated in the present terms. So we will find the present value of all the future cash flows. Market based approach, this determines the comparable company, comparing the target company to the similar type of companies and then doing the valuation. Asset based or cost approach, it calculates the company's value by the fair market value of the assets by subtracting total liabilities from total assets. Stock and debt approach, it includes the equity and debt and adjusted book value. In this, the value of all the things are adjusted according to the fair market value. No historical costs are included. Now, next unit is all about unit number 14. Unit number 14 is discounted cash flow valuation. Discounted cash flow valuation means when doing a valuation, two methods are there. One is discounted cash flow valuation. Another method is other non-discounted cash flow valuation. It means what? In doing the valuation, you are doing the discounting of the cash inflows. And second method says that without discounting, how you will going to find the valuation without considering time value of money. So without considering time value of money, here we will take the enterprise value multiples. All right. So what it says, estimating DCF input. So four components are there. How to estimate the discounted cash flow value input. First, you will see that what are the future cash flows. You will predict the future cash flows of the company, estimate the future cash flows of the company. After estimating, then you will convert those cash flows into the present scenario. So you will, for converting the cash flows into the present value, you need discounting rate, a discounting factor. So as the level of the risk is, that is the discounting factor. If the risk in the company is very high, so high discounting factor is there, and vice versa. Then the growth rate, at what rate the company is growing. Company is growing at a rate of 10%. Company is growing at a rate of 12%. Company is growing at a rate of 20%. So what is the estimate growth rate of the company? And pattern of growth means how the company is growing. Company is growing in the constant way. Okay, the constant way in the sense the growth rate of the company is zero constant. The growth pattern of the company is zigzag. The growth pattern of the company is sometimes high, low, then stable, then low, then high, then stable, then low, like this. So you will estimate what is the pattern of the growth of the company. Clear? Now, next are the different approaches to discounted cash flow model. So, see, all these approaches are very important. First approach talks about the cash flows. First approach is based on the cash flow of the company. Second approach is based on the earnings of a company. And third approach is based on the growth pattern of the company. So remember, first approach based on the cash flow. Second approach is based on the earnings of the company. And third approach is based on the growth of the company. So what is the first approach? If I want to purchase another company, so I will ask from the seller, is it possible to estimate your cash flows? If the seller is saying that yes, you can estimate my cash flow, then next question I will ask, what is the type of leverage? What is the type of risk in your company? Risk level. Is the risk level same? Means you are having a risk of 2% every year. If it is static, if it is same, constant, then I will use free cash flow to equity. Free cash flow to equity means the amount that is left for the equity shareholders. So what is the amount that is left for equity shareholders? The PAT. Yes, yes, profit after tax, free cash flow, because this is the only profit now that you will distribute to your shareholders. Next, if your risk is not static, it changes. Means sometime it is 2%, sometimes it is 5, sometime it is 7. Then in that case, I will use the cash flow that is available to the firm. And what is the cash flow that is available to the firm? It is known as no flat. Net operating profit less adjusted tax. It another name is also known as the EBIT, operating profit. Clear? And if it is not possible to estimate cash flows, then I will use the dividend discount model. Dividend discount model is finding how to find the value of the stock price of the market share. So that is D1 upon KE minus G. In this way, we will find the price of the stock, price of the share. Or if you want to find the cost of equity, then what is the formula? D1 upon PO plus G. So these are the two ways through which we find the stock price, the price of the share in the market, or the cost of equity. Then second is when the earnings are when second approach is based on earnings. So I will ask that what are your current earnings? You will say that, see, I means I am the valuer. And to whom I will ask? I will ask from the seller if I'm purchasing his or her company. So I will ask, what are your current earnings? So you are saying my current earning is positive and normal. So I will use the current earnings of the company. If you are saying my earnings are abnormal, it is negative. Abnormal means sometimes very high, sometimes very low, sometimes negative. Then I will ask whether you are making the current earnings or not. So you are saying that yes, my company is making the current earnings. So in that case, use normalized earnings in place of current earnings. So normalized earning in place of current earning means it means like company what profit the company is making, like after removing any kind of unusual things, okay, that happen once in a year or once in a month. So after removing those profit, what is the actual profit the company is making? Let's take an example. Let's say the company has earned 10 lakh this year, but from 10 lakh, the 2 lakh came from selling the old building. So this selling the old building, it not happens regularly. You will not sell the old building or machinery or assets on a regular basis. Okay, it may happen once in a month, twice in a month, or it may happen once in 6 months, once in a year. So this is not your regular job. This is not your regular way of generating income. So normalized earning, what it says that the one-time earning that has happened, deduct all those earning after removing all the unusual earnings that happened only once a year, once a time, remove that, and whatever value comes, that is the main amount the company is generating. So that is 10 minus 2 lakh is what? 8 lakh. That is the main amount the company is generating. So use normalized earning in place of current earnings. Then if you are having no current earnings, then again I'm asking whether survival is possible. You are saying yes, then do some adjustment and then take those earnings. If you are saying that no, survival is not possible, again I'm asking the same question, whether your firm is over debt with leverage. You are saying yes, then value equity as an option to liquidate. So I will take that value which is left for the equity shareholders. What? Equity shareholders, wait, I guess it's not visible. Value equity as an option to liquidate. So that is what? That is the residual value of the equity. And estimate liquidate value is what? Estimating liquidate value, that is whatever the value that is left for the whole firm. Whole firm. Clear? Understood? All right. Just have a look if you are. See, this is the residual value of equity and the residual value of the that is left for the whole firm. Next is based on the growth pattern. So present, what is the present growth? So if the growth is less than the economy growth rate, then in that case use stable growth model. If the growth pattern is more than the, if then again I'm asking whether your firm is competitive advantage. Yes, use two-stage model. If no, then use three-stage model. WACC is what? WACC is the weighted average cost of capital. It is the minimum required rate of return that the company has to pay to their investors and shareholders. What is the, why WACC is important? So if WACC, see, if the returns are higher than WACC, good investment is. If returns are less than the, if the returns are less, the cost of capital is high, then it's a bad investment for the company. Then next is different stage of model, two-stage model, three-stage model. Two-stage dividend discount model, what it says that the dividend will grow in different times, two distinct period, the dividend will grow at a different rate. So first is high growth rate is first the growth rate is high and then the growth rate will constant forever. So that is what? That is the two-stage model. So high growth rate for the first year and after high growth rate, the dividend will grow at the constant rate forever. So D1 stands for, this is the formula. And what is the growth? This is the two stage. So growth is high. Okay, growth is high. G, okay, G2, then G1, and then it becomes what? It becomes constant forever. So that is what? That is the stable growth rate. Then three-stage model is the combination of two-stage and H model. And in three stages are there. High growth stage, then dividend slows down, slows down, the growth phases now became slow, and then it will attain the stable position. So that is high growth phase in the first, like the dividend is growing at the high rate of 10%, then 15%, then 20%, then 25%. After that dividend, the growth rate of the dividend is slow. The growth starts to slow down gradually. Now the growth is 24, 23, 22, and the at 20 the company becomes stable. The dividend growth rate is now 20% till the entire year. So that is what the three-stage model, and it is the combination of, this is important, it is the combination of two-stage and H model. All right. High growth phase. First, initially, company will grow very fast. Then, company growth rate is slow, and then company will become stable. So this is what for high growth rate. Then transition phase is there, and then stable growth rate is there. Next is H model. Very important. H model. This is the model used to find out how the dividends pattern is, how the dividend is growing, and to calculate the market value of the stock. In this, again, in this model, the company growth starts but slows decreasing over time to stable rate. See, in three-stage model, the company is growing at a high growth phase, then company slows down and then company becomes stable. But in H model, it consists of two stages. One is growth starts at a DA, growth starts at a DA, then decreases slowly. Decreases slowly means decreases linearly. In a linear pattern, the growth will decrease until it becomes the stable. So this entire is the one stage. It is denoted as GA. This is GA, and this is what? This is the second stage. It is denoted as GN. Now you will have one confusion, that how to know that whether the question is asking H model or two-stage or three-stage model, because both are lump sum same. Difference is that in H model, the question will say that the growth, the dividend, these are decreasing in a linear pattern, in a linear way. Means every time the decrement is 2%, 2%, 2%. This is what? This is the linear pattern. And what is H? H is the half growth period. So if it says that the dividend will be stable dividend, the growth of the dividend will last for 20 years. It means H is what? H is divided by 2. So H is, if it is 20 years, so what is the value of H? 20 divided by 2, that is 10 years. So this is denoted by H. H is half of the growth period. So here growth starts quickly, then decreases at a linear rate until it becomes stable. So earnings growth rate decreases linearly. This point is very important. From GA to GN. GA is increasing very high until it becomes stable. That is GN. So dividend paid over here is constant. Okay, so this is the H model. So dividend is increasing. See the growth rate is there. Then it decreases at a linear rate and then it becomes stable. So this is GA and this is GN. Clear? So initial growth rate is denoted as GA and the normal growth rate, the stable growth rate is denoted as GN. And this is the formula. How to find the market value of a stock? So DO plus 1 plus GN. Remember here the dividend of the previous year is taken over here. Okay, previous or the dividend of the present year is taken. D1 is not taken over here. D1 is what? That the dividend get to receive a dividend of the next year. So DO is taken the dividend of the previous year. 1 plus Gn plus H into Ga minus Gn upon R minus, or if the D1 is given, then the dividend will be previous year of the dividend will be taken. GA is high growth rate, Gn is the stable growth rate, R is the required rate of return, and H is half. So these are the few difference between 2-stage, 3-stage H model. Then next we have non-discounted cash flow valuation. So two methods are there, DCF, non-DCF. In DCF, relative is their equity, non-DCF, enterprise value, book value, and stock and debt approach. So relative valuation is just the same like your comparable method, your direct comparison. Like for example, if you want to find the actual valuation of the target company, but the data is not available, so you will see the comparable company. You will find the comparable company and those comparable company data you will put in your target company. Like for example, if you know that in your area what is the amount of 1 acre plot, so you will see that who has sold or bought any plot in your area. So you concluded that the person has sold the 2 acre plot for rupees 10 lakh. It means 1 acre plot is sold for rupees 5 lakh. And you are having 5 acre plot, so you can easily calculate the value that if 2 acre plot is sold at rupees 1 lakh, then the value would be 5 into 5, 25. Equity valuation multiple. So these are all the equity valuation multiples. In this, it estimates the value of the company's equity shares, that is the shareholders, by comparing it with the similar companies. P multiple, PV, PS, and relative PE and PEG ratio. So P, price to earning, what it says how much investors are willing to pay 1 rupee of current or future earnings in your company. If your company is earning 1 rupee, then how much investor has invested in earning that 1 rupee. So it stands for MPS upon EPS. And this is the formula. 1 minus B stands for dividend payout ratio. R is the return on equity minus R is the rate of return, cost of equity, minus ROE into B. B is what? B is the retention ratio. If B retention ratio means the amount that you have kept, and 1 minus B is what? The amount that you have paid to your shareholders. Like you have 100 rupees. If you have paid to your shareholders 60 rupees, how much you have saved? You have saved 40. So 40 is what? 40 is the retained earnings. So retained earnings is known as the retention ratio. And the amount that you have paid is denoted as 1 minus B. So retention ratio is also known as plugging back ratio. Then relative PE. So relative PE, it tells about how much the value of the stock is high or low. So stock is expensive compared to the benchmark, means your instrument is expensive as compared to the market. Instrument stock is cheap as compared to the market standard, and the stock is fairly valued. So PE is greater than PE greater than 1 means the stock is expensive, less than 1 stock is cheap, and equal to 1 stock is fair value, means in market also the value of the stock is 10% and your company also the value of the stock is 10%. Like example is given in imagine a mango costs rupees 100. If a shop sells it for 45, it is expensive. If shop sells for 30, it is fairly valued. And if shop sells for rupees 20, it's a good deal for the customers that we are getting the value at low cost. So the same goes for the stock. Price to book value means MPS upon BPS. What is the value that is present in your books of account? So book value is calculated by total assets minus total liabilities upon outstanding shares. And this is the formula of book value. ROE, return on equity, into 1 minus B upon R minus G. R is the rate of return minus growth. And remember in module C, all The questions are based on the formula type. So do remember all the formulas. Okay, the formula sheet is already shared on the Telegram. So go through those things. Clear? Now, next is what? That is the price to sales. So again, PS ratio, price to sales means that how much the company has done the sales. If company wants to make the profit, so how much company has to do the revenue against the market valuation of the shares. So it compares a company's market valuation directly with how much the company has earned revenue or how much the company has done the sale. Sales means what? Revenue is generated from what? Revenue is generated through sales. The more sales you will do, the more revenue you will generate. The less sales are there, the less revenue you will generate. So what is the formula? That is MPS upon revenue per share. Revenue per share means sales per share. Then enterprise value, it includes all the elements of the enterprise, whether it is debt, whether it is equity, all the things are included in this. So moving beyond just the shareholders, enterprise provides a holistic view, means overall view of the company. So market value of equity, so all the, see here we will not take the book value or the company value. Here we will take the market value of all the equity shareholders plus the market value of the debt, all the short term, long term debt minus cash and cash equivalents. Why cash is deducted over here? Because this is the only cash that is used to pay the seller. Okay, if you are buying any company, so you will take the equity, you will take the debt, you will calculate what is the market value of its equity, what is the market value of the debt. Now the cash, the seller will pay that cash only to you um, in order to sell the company. So cash and cash equivalent is what? This is the, see, if in company, if the cash is present, you will not going to take cash. Why? Because you will take its debt. Okay, you will take the equity, but cash you will not going to take. Like I'm giving you, I'm giving you any gift, but by mistakenly I have put 500 rupees in that gift. That is mistakenly. So will you accept that 500 rupees? No, you will, or you will return me that, see, I have got 500 rupees. Okay, or by mistakenly you have given me 500 rupees. So the cash is not taken by the company, else the equity, debt, all the things company can take. That is why cash and cash equivalent is deducted when calculating the enterprise value. Because in enterprise value, the value is only justified with their stocks, with their securities, with their current liabilities, long-term liabilities, not with the cash. Cash is what? Cash is the liquid amount. Clear? So why subtract cash? Because a theoretical acquirer could immediately use the company's own cash to pay off the portion of purchase price. So the acquirer, the one who is acquiring the company, that acquirer will pay that cash only to purchase the acquiring company, to acquire the target company. To purchase the target company, not acquiring company, target company. That is why cash is not included. Then we have in enterprise value model. Okay, we include both debt and equity. And in debt and equity, what are the different multiples? So EV upon EBITDA, EV upon EBIT, EV upon FCFF, that is free cash flow to firm, free cash flow to firm. And what is free cash flow to firm? That is no plan. Net operating profit less adjusted tax, EV, BV, or EV upon sales. Now, so different, all these enterprise value multiples are, the formulas are very important. So enterprise value upon EBITDA means earnings before interest tax, D for depreciation and A for amortization. So depreciation is used for tangible assets and amortization is used for intangible assets. How to calculate? See, if simply if the market value of equity is given, market value of debt is given, cash is given, so you can calculate in this way, the enterprise value. But if these are not given, return on invested capital is given, growth of the company is given, then weighted average cost of capital is given, then you have to use this formula. So ROIC minus growth into 1 minus GS for depreciation amortization into 1 minus taxes upon ROIC into WACC minus growth. So EV upon EBIT, it is defined as enterprise value upon earnings before interest and tax. So 1 minus one minus T means taxes into 1 minus reinvestment rate. Reinvestment rate is, see, just now we have seen V. Just now we have seen 1 minus B. B is what? B is the retention ratio. Okay. And 1 minus B is what? That is the DPR, dividend payout ratio. So see, company, when company makes profit and company gets another kind of deal, so company will reinvest, company will invest in in that investment also. Company will do further investment also. Now, what money company will use? Company will use that money only, na, that the company has made profit, the money that you have kept as reserve, the money that you will use as for emergency period. So that money only you will use for further investment. So reinvestment rate is what? Reinvestment rate is also known as the retention ratio, and it is also denoted by B. Clear? And WACC minus growth. Then EV upon FCFF is what? This is very easy formula. 1 upon WACC minus growth. EV upon book value, enterprise value upon book value, that is what? ROIC, return on invested capital. The investments that you have made, the amount that you have invested on the capital, how much you are getting in return. That is what? Return on invested capital. What are your expectation? What are your expected returns from the investment that the company has made? That is ROIC. The company has done the investment from their core operations. So what are the returns that company is expecting? That is known as ROIC. Minus growth upon WACC minus G. Like question is there, Vivek company has an ROC of 18%. Okay, ROC given how much? 18%. Can I write 18% as 0.18? Yes. Growth rate is 11%. Can I write growth as 0.11? So WACC minus growth 0.11 upon 0.13, that is the WACC, and growth is same 0.11. So how much times it will come? That is 3.5 times. That is 3.5 multipliers. And this you will use to compare your target company. This amount you will use, this multiplier you will use to find the valuation of target company. Then EV upon sales into multiples. So EV upon sales is after tax operating margin. After tax operating margin is what? In short, you can say this as the ATOM, that is atom after tax operating margin. So after tax operating margin, it shows how much profit, how much operating profit a company keeps from like from each 1 rupee of the sales that company is doing after calculating the taxes, but before all the interest cost. It means how much company is making, how much operating profit company is making by making a sale of 1 rupee. Like if you are making the sale of 1 rupee, okay, you have done the sale of 1 rupee. Let's say that you have done the sale of 100 rupees, and from that 20 rupees the taxes you have paid. So what is left? The 80 rupees you are left with. Now this 80 rupees is what? This is the operating profit. So atom, that is after tax operating margin. So this is the same EBIT into 1 minus tax rate, the NOPLAT upon the sales. Now 1 plus G, 1 plus G is what? That is 1 plus the growth pattern. 1 minus reinvestment rate is the B, reinvestment rate, or RR we can say, upon WACC minus growth. So question is, planned limited after tax operating margin is how much? 0.11. 1 plus G is how much? Growth is 9. So 1 plus 0.09. All right. Then into 1 minus reinvestment rate into 1 minus what is the reinvestment rate? 0.70. Upon WACC, that is 14%. So 0.14 minus growth 0.09. So if you will calculate, you will get 0.72 multiple. Next is all about the special cases of valuation. See, apart from all the different types, we have seen done discounted cash flow valuation, non-discounted cash flow valuation. Now, next comes that is the special cases of valuation. Now, some of the when normal methods they do not work properly, then specialized methods comes, that is known as the special cases. So some of the companies they need the special type of method for doing the valuation. And what are those companies? Intangible companies operating in intangible assets, the startup companies, the real estate companies, the financial services companies, the loss making firms, or distressed nature of companies. Distress the nature of companies, then e-commerce companies, and cyclical and non-cyclical companies. So these are some of the companies which need a special type of requirement for doing the valuation. So what are the approaches to for the intangible companies? So we will see the capital investment. If the more capital investment the company has done, it means the more amount the company has invested on those intangible assets for generating the goodwill, for generating the more returns in the company. So estimate value by aggregating means how much expenses the company has done in the past, including the advertisement, including the for brand building. See, advertisement and brand building is also a long-term investment because these will add the value in the company. So those things which add value in the company and it gives you do the value for the long term, it is included in capital investment. Then discounting is done. That is again time value of money is considered. So we will discount the all the cash items of the intangible assets, and relative valuation means compare the market value of the firm with all the intangible companies, other intangible companies, like another company who is working in the intangible assets only. So find the value of that company and then use that value to find the value of your target company. Okay. Then next is what? Next is all about the startup companies. So how the startup companies, what are required? Startups are what? These are a new type of company, a scalable company who is just initially these companies have started and they have the potential to grow in future. So how to do the valuation of such companies? So first the valuer will ask what the valuer will ask. Valuer will ask that what is the current status of your company. When you have got the answer, the current status of your company, then again you will ask that is there any growth pattern in your company? How much your company will going to earn revenue in future? So after that, the third step, the company says that okay, we have decided that we will make the growth of 20% in coming year. But if not 20, then the minimum growth would be 10%. The 10% growth is the minimum. It will not going to decrease that. So operating margin is what? That is how much company is going to, what is the margin the company has kept, that the least margin the company has kept, that company will not going to make revenue down from that. That is what that is said. Then whatever funds the company has generated, whatever revenue the company has generated, then the company will do the reinvestment. So how to do the reinvestment? How to find the expected growth in reinvestment? That is reinvestment rate into return on capital. This is the formula to find the growth of the company. If growth is not given, then one more way to find the growth is reinvestment rate. Yes, reinvestment rate is what? Reinvestment rate we have denoted as B, also retention ratio into return on capital. So reinvestment, estimate a reinvestment to generate growth. So expected growth is RR into ROC. If you know one, you can find the formula of other also. Then for knowing the growth, because the discounting is done, you should know what are the risk and discount rate. So kappa model you will use, or the risk free interest rate, that is beta you will use, or you will use the APT theory. So different ways is used to find the discounting rate of the company. And at last, then the firm value will be analyzed. In the firm value, non-operating assets are not included. Operating assets are included. Non-operating assets are those assets that are not directly related to your core business. They may help you, they may affect the company in different way, but these are not directly related. And then the equity value is calculated. So what is the value of the shares in the company? So this is all about the startup companies. So different steps are followed when doing the valuation of the startup companies. Next is the financial services company. So how these companies, what are the how the valuation will be done of these companies? So financial services companies, certain features are included in these companies. First is these companies, financial companies, these companies they use debt for earning income. Yes, their core purpose is what? Their core purpose is finance. Their core purpose is to lend money to borrowers. That is how the company will earn. That is how the bank will earn the money. How bank earn the money? Bank earns the money by the interest they are charging, okay, from their customer. So dues of debt is high in these companies. Then these sectors are very heavily regulated sectors. RBI norms have to be followed. Okay, the SEBI norms, the ADA norms, they have to be followed. Then difficulty in measuring reinvestment. See, the banks they cannot generate that this year we have made the profit of 20 crores, so for sure next year also we will make the profit of 20 crores. So it's not possible to do the reinvestment. It's not possible to measure the reinvestment. How much bank will going to reinvest in next phase? Might be if the economic downturns are there, if the economy uh, any financial crisis is there, then the money will be used in that purpose, not in reinvestment purpose. Banks they have to follow capital adequacy norms, then difficulty in choice of multiples. So you cannot compare two banks. Can you compare the SBI bank or okay, can you compare the Bank of Baroda and I and the PNB bank? No, you cannot compare two banks, so it is difficult to find the multiples. And in this, the provisions are high. Bank has to maintain a lot of provisions. Bank has to keep a money aside for covering their unabsorbed losses. And government directives are important in making the choices. Then e-commerce enterprise. So in e-commerce enterprise, mainly the business is done through the online transaction are there. So these include the future technology, the habits of individual, the advantage and disadvantage of conducting business, the competitors, the taste and preference of the individuals, the outsider factors, what are affecting. So these affect a lot in e-commerce enterprise. Then one most important topic is that is cash and near cash investment. So what it is said that John Maynard Keynes have said that the companies they need cash for different purpose. So three motivations are there for individuals. That is why they need cash in their company. What is that three motivation? First for transaction. Okay, second for any kind of unplanned expenses, and third for speculative purpose. So the cash is needed for the regular transaction. Second, the cash are needed for any kind of unplanned expenses are there. Any bad circumstances came, any kind of natural calamities are there. So for that, the cash is needed. And if the bank gets any kind of new opportunity, like any new investment the bank has got, the new projects the bank, the not bank, sorry, company has got, not bank, the companies have got, so company will invest in all these things. That is why the companies need cash for three of the purpose: for their daily operations, okay, for their unexpected expenses, like if any kind of bad things happened in the company, and the investment opportunities if company has got the better opportunities to invest in different projects, then and for making the management decisions. So sometimes managers they need huge cash, like for manager has taken any decision. So when decisions are made by the manager will set the budget also, like finance department budget, operation department budget. Okay, then marketing department budget, production department budget, what is the budget for the employees? So all these budget are decided by the management. That is why managers they also hold extra cash. All right. Next is some of the bad decisions are taken by these companies. That is why these companies comes under the distressed nature of companies or loss bearing company. Now, what are the bad decisions the company has took? So one case study is of Kodak, next is of IBM, and third is of Xerox. Now, Kodak did not understand the technology well. Kodak company did not work on the digital camera well. Kodak was busy in acquiring the Fuji films, and it led to the distress of this company. It led to the this company disrupted entirely. So it ignored the digital shift despite inventing it spent modest acquisition. So Kodak was busy on the acquisition process. Kodak thought that if I will acquire the Fuji films, then everything will be in my control. But on the other hand, Kodak has not figured out that the technology is changing. I should work on my camera well. If I will work on my digital camera well, then I can lead the entire market. But this was not the thought of the Kodak. Kodak was busy in acquiring the Fuji films, and on the other hand, Fuji films was busy in making their camera more better. That is what the thing failed in Kodak, and most of its business, most of its share fell. That is greater than 50% in the year 2004. And this company was entirely failed in year 2004. Then similarly, IBM International Business Machine. So this was the company who made the operating system, but this company does not sold the operating system in its own name. This company sold the operating system to the Microsoft, and Microsoft sold that in its name. So this company also lost its existence completely at that time when in the year 1989. So it gave to the newcomer Microsoft and its market value entirely erased. Xerox has also done the same thing. Xerox could not understand the technology well. The new things were invented, the new technology came, and Xerox, this is the company that was busy in working on their old type of printer. Xerox was the old type of printer machines were there. This company followed the old technology only, the dot matrix printer. Okay, but the pattern has entirely changed. Now the plotters are there, the ink matrix, the new type of printers are there. But the Xerox have used only the old type of printer, and with this the entire market failed because Xerox company did not adopted the new and latest technology at that time, and it failed to commercialize it. So these were the three different case studies, and from any of the case study, the question may come in exam. Any doubt to anyone so far? And one request from you all that please do like the session, share it with others as well, and don't forget to subscribe the channel. All right, so let's start with the next chapter, that is mergers and acquisition. So what is mergers? What is acquisition? Mergers and acquisition means, see, merger means when two companies they are coming together, like company A and company B, both are merging and they are forming a new entity. So it is either A or it is either B. If A is merging into B, if A is merging into B, so A's existence will be lost. Or if B is merging into A, then B's existence will be lost. So only one company existence will be there. So that is either A or either B. Acquisition means what? When A is acquiring the B company. So definitely the B company would be a smaller company. Then only A has acquired the B company. So has acquired the B company. So A becomes a parent company of B. And one more term is there that is known as the amalgamation. So what is amalgamation? Amalgamation means when company A is merging with company B and they are creating a new entity that is known as entity C. In merger, only one entity will exist, either A or B. In amalgamation, entirely a new company is created. A and B, they have lost their existence and C is created. And in acquisition, one big company is acquiring the small company. And that small company is what? That is target company. The similar type of company it could be, or the small company it could be. So one is the acquiring company and another is target company. Okay, so what are the fundamentals of mergers and acquisitions? So merger means combination of two or more companies into one single unit. Why? What is the benefit with this? So it involves companies of similar size. Okay, the collaboration is done. Collaboration is there in these two companies. They are coming so that the competition will be less and they can work in a more better way if both are coming together. Acquisition means when one company acquires, one company buys another, one company gains the control of another company, one company takes all the shares of another company, their operation, that is called the acquisition. Okay, like this is the big company, this company has taken the small company, that is acquisition. Acquisition, it can be friendly also, it can be hostile. Friendly and hostile means when both the party are ready that, okay, I'm ready to sell my company and you are ready to purchase my company. That is what friendly acquisition. But if I'm ready to buy your company, but you are not ready to give me your company. The seller is not ready to sell their company. So in that case, the takeover, the acquisition is known as the hostile acquisition. Then different types of mergers are there. Horizontal merger when companies they are related in the same industry, like two shoemaking company are coming together. That is horizontal. Vertical means when company they are related in the same manner but in the different stages of production. Like supplier manufacturer relation is there, or customer bar customer shopkeeper relation is there. So that is known as the vertical merger. Market extension means market extension merger is when companies one both the companies are merging to expand their market into different geographical areas. Co-generic merger is what? When company is merging, when the companies are producing the related product, means complementary product. Like for example, car manufacturer is there and one is the car component. So one is making the component, and one is assembling the component, all the component of the car and making the model of car. So these are what? These are the related industries with complementary product. Like home appliance maker is merging with the motor manufacturer. Conglomerate means when companies they are related in unrelated industries for diversification. Like shoemaking company is merging with food and beverages company. So this is conglomerate merger. And reverse merger means when a small company takes over large company, or when an unlisted company, smaller unlisted company is taking over a larger company, that is known as larger listed company, that is known as reverse merger. So it is the opposite of normal merger. Acquisition was in acquisition, one company is the acquiring company and another company becomes a target company. So acquisition, the acquirer buys another company, that is the target, to gain all the control of their assets, operations and resources. So acquisition is friendly acquisition, hostile acquisition. What are the reason for acquisition? Market expansion. If one needs to expand their market, if one needs to diversify their risk, or the cost synergies. If companies they want the benefit of when two companies are coming together, like value of company A and B will always be greater than value of company A alone plus value of company B alone. So if two companies are coming together, they should always give more benefit, more value when they are working alone. Value of A and B, suppose value of company A is, let's take an example, 100 crore. Value of company B is, let's take an example, 120 crore. When these two companies are coming together, so they should give the value of approx 250, 300 crore. Then only it is known as the synergy. Synergy means the benefit of combining two companies for strategic growth, for the growth purpose, and for eliminating competition in the market. That is why the acquisition is done. Now, takeover is done in many ways. The open market, when the company has company is ready to do the purchase. Open market, companies open in the market that anyone can purchase that company, the one who is ready. Negotiated acquisition means when the acquirer and the target company both are having the negotiation in the value. And preferential allotment is what? When the allotment is done on the basis of preference. A lot of preference is given to the person. Means when a company is, suppose any company is ABC. This company is issuing shares or securities to a group of their investors, to a group of their people, to a group of their shareholders, and these are issued at a discounted price. Discounted price means the value of share is 100 rupees, but this company is issuing their shares to investors and shareholders at 80 rupees. So this is what a more preference is given to your investors and shareholders. That is known as preferential allotment. So it is the process where a company issues shares or securities to a select group of investors at a discounted price. Why? To raise capital in the company. Then takeover is done. So when the takeover is happening, so it should made clear that it should be done in the fair manner. Transparency should be there. The protection of minority shareholders. Sometimes what happens, the major shareholders they take part in the company, but the minority shareholders they are not allowed to participate. So it's the responsibility of the company to protect their interest also, and prevention of any kind of illegal or unethical matters. Then the SEBI takeover code, when the takeover is happening, when the company is taking over another company, so certain provisions are there that has to be followed, and all those provisions are included under SEBI regulation. What it says that a certain disclosure has to be made. When the acquirer is acquiring the company, okay, more than 5%, then the disclosure is made. When what is the trigger point? Acquirer makes a public announcement to the acquiring share through the public offer. So when acquirer is making a public announcement, in that case, the acquirer should make clear that, okay, how much shares I'm purchasing, at what value I'm purchasing, who is liable for that, who will going to become the new shareholder. So all these things are to be mandatory. These need to be disclosed. And if the shareholders they are buying more than 25% of the share, then in that case, the acquirer has to make public announcement. What public announcement? That I'm ready to purchase I'm purchasing the shares of these companies. The merchant banker is made, the acquirer is need to required to hire a category one merchant banker with the who is registered with SEBI before making any announcement. So before making any kind of announcement, the acquirer has to hire one person. That person is known as the category one merchant banker, and this person will check all the rules and regulations before making the final announcement. So after that, once the merchant banker is hired, then the acquiring company will make the public announcement within 4 days after the information is collected. After the information is collected, after the merchant banker is hired, then it's within 4 days the public announcement is made and all the information is provided to the people that what at what price I'm ready to buy, what is the object of acquisition, what is the motto behind this acquisition. Then in detail, the offer price should be the price should be mentioned to the general public. It should be offered to the general public. All the responsibilities. So letter of offer is delivered to the shareholders within 45 days. So because ultimately, if you are acquiring the company, you have acquired the company. Now the new shareholders will be there. So you have to give the letter of offer to the shareholders within 45 days. Within 45 days means after doing the public announcement, it's within 45 days you have to provide the letter to the shareholder. Then obligation of the board of the target company. So when the everything is settled, okay, that yes, now the acquiring company will have to acquire the target company. So in that case, the target company is not allowed to dispose of their assets, or they are not allowed to do any kind of deal with any other party, or to enter any significant contracts, because now the target company is ready to sell its everything. So in that period, they cannot dispose of their assets. Then after the release of the initial offer, so within 21 days, the public will release the initial offer. The competitive bids can made. So bids from competitor means, okay, the target company, it is open in the market. Any other competitor, any other acquirer can also purchase this target company. So for that, within 21 days of the public release of the initial offer, after the offer is released to the public, then the competitive biddings can be made within 21 days. Whatever funds have been collected, the amount from the target company, that funds would be kept under the escrow account. Escrow account is also known as a type of safety account where all the funds have to be kept. How much? Suppose the cost of the target company is, let's take an example, 150 crore. So up to 1 crore, up to 100 crore, at least 25% of the amount is included up to 100 crore. So what is the 25 crore of 100 crore? That is 25 crore. And how much is more than 25? That is 50 crore. So it's 10% amount will be kept. 10% will be kept in the escrow account. So what is 10%? That is 5 crore. So it means 25 plus 5, 30 crore will be kept in the escrow account. Understood this? And if the acquirer has already owned between 15 to 75% of the target company, then in that case, the acquirer is not allowed to give the public information. The acquirer can gradually, like 5%, 10%, the acquirer can gradually, you can say, can gradually take over that company without any kind of giving the public offer or public announcement. Okay, without triggering offer rules means without giving any kind of information to the public. Now, next is, see, so far we have done the acquisition takeover process. We have also seen there is friendly acquisition and hostile acquisition. If the friendly acquisition is there, then okay. But if hostile acquisition is there, then how would a target company defend itself? So there are some anti-takeover defense mechanism that is used by the target company so that the company can save itself from being getting acquired under acquiring company. So two things are there. One is pre-offer is given. Before the offer is given by the acquiring company, certain things are there through which the target company can save itself. And after the offer is given by the target company, then certain things are there. So staggered board is there, super majority clause is there, means like in staggered board, Not only one director is there, multiple directors are there, and every year and one new director is changing. So in that case, it becomes difficult for the acquiring company to finalize the deal. From which director the acquiring company will finalize the deal? Or at the same time, you cannot remove all the directors. So that is why it becomes difficult for the acquiring company. Then dual class shares is, so some of the shares are given at discount to the shareholders. If the shares are given at discount to the shareholders, then shareholders will purchase more shares. So it will make expensive in the eyes of the acquirer. So acquirer will see that the shareholders of these company, they are having much more shares. In amount of the shares are very high. The quantity of the shares are very high, but they don't know actually the acquirer is unaware that the shares are offered at discount, but the acquirer is seeing what the amount of shares, so it again makes the expensive to the acquirer. Then golden parachute are there, so it is being stated that the if the company is getting acquired or if the company is a target company, then in that case, the one who is acquiring the target company will have to pay huge compensation to their chief executive level person. The individuals who are at the executive level post, the like CFO, CTO, CMO. So that is what golden parachute is. This is the thing that will help the company to get to save their company from getting acquired. Then post offer we have green mail, Pacman litigation. Green mail is what that is green mail Pacman. It is what like for example in green mail the shares whatever shares the acquiring company has taken from the target company. Now the target company is buying back those shares at a premium. That is the green mail. Pacman is what Pacman is once the seller is becoming the buyer. Okay, acquiring company says that I want to acquire your company at rupees 50 crore. So target company says that okay, you want to acquire my company. I'm ready to do the acquisition of your company worth rupees 60 crore. Are you ready to give your company? So that is what once the seller was target company is now becoming a buyer. So he is giving the counter bid offer. That is the Pacman. Then certain laws. So target company will say that you are not following the proper rules and regulations. So I will not let you my company to be acquired. Restructuring, okay, selling the crown jewels. So these are all the different types of defensive mechanism. So how target company will resist the hostile bid? Bidding is done by whom? The acquiring company. All right, so these are all the pre-offers, staggered board, supermajority, poison pill, poison put, dual class, golden parachute. Then golden parachute, okay, this example is like cost multiplied. CEO says that I need the compensation of 5 crore. CFO says that the 3 crore. So total 8 crore extra money the acquiring company has to pay to the target company in order to have the benefit of golden parachute. Then Pacman defense. So here the target makes a counter bid offer. Green mail is what again the target company pays a premium to buy back its own share, or the target company is selling their crucial assets, okay, so that it becomes unattractive to the buyer. So if they are selling their crucial assets to someone else, now the company is left with no assets or very less assets. So the value of the company will decrease, and if the value of the company will decrease, it becomes unattractive to the buyer. Then liability restructuring. So the target company is issuing the fresh shares to their friendly third party. And litigation means if the target company says that you're not following the proper law, rules, and regulations, I will not give my company to you. All right. Staggered board we have done. Super majority clause means the for the like the high vote of percentage are required for any kind of approval. If the target company is being ready to sold, so in that case, the super majority clause will work, will save the company. So super majority clause, what it says, the highest approval is required, then only the company will do next proceedings, otherwise not. Poison pill, so here shareholders are given the right that they can buy the shares at discount. Poison put means the company can buy back the shares early and company can free their shareholders and it becomes again less attractive. Dual class, this all this both we have done. Now, some of the anti-takeover defense in India. So, preferential allotment, this we have done means a preference is given to the existing shareholders that they can buy the shares at a discounted price so that they can have more control in the company. Creeping enhancement means the shareholders, the promoters, they will increase their stake in the company, not instantly, but gradually. The company can amalgamate, like company says that okay, this company is acquiring me company A, so let's amalgamate. So B and C, these two companies will amalgamate and they make a D company. Or selling the crown jewels. Or white knight is what? White knight means a friendly company or a friend of you will come and help you in your bad times. That is what the white knight. So the company is taking help from their friendly company, that is white knight, to defend against the takeover. Now, next is all about LBO. LBO is what? When the company is acquiring another company with the help of loan, with the help of debt, with the help of leverage, that is known as the leverage buyout. So, leverage buyout means acquirer will take a bank loan to buy a target company. Once the acquirer has the target company, now the target company revenue will be used to repay the amount to the bank. Once the amount is repaid to the bank, the acquirer is left with only target company. So when acquirer feels that when the right time comes, now it's the right time I should sell this company and make high profit. So at that time, the acquirer will sell the target company and make high profit. This is how the LBO works. So LBO is basically it provides the assistance of loan so that company can do the acquisition process. And we have one case study on Tata Tea and Tetley. So Tata Tea was the Indian company. This Indian company has acquired the Tetley company with the help of loan financing, with the help of leveraged buyout. What you have to remember all about the net worth and acquisition cost. So a Tata company was the Indian company. Tata company wants to acquire the Tetley company, but the value of Tetley company was 450 million. Value means the acquisition cost was 450 million and Tata Tea was having only 114 million. Now Tata Tea took most of the amount with the help of debt, and with that debt, the Tata Tea has acquired Tetley Tea. So it was the first acquisition made by an Indian company utilizing a what leveraged buyout strategy. Providing strategic debt can overcome massive scale disparities. So this is the first LBO that was conducted in the history of Indian, that is Tata has acquired Tetley. Then acquisition is done. So Tata has acquired the Tata, not Tata Tea, the Tata company. This has acquired the Jaguar Land Rover. When on June 2, 2008, but it was initially the acquisition was done on March 26, 2008. And all the acquisition cost was paid in cash transaction. So what was the acquisition? The acquisition was 9,200 crores. So acquisition cost was 2.3 billion, which is equivalent to 9,200 crores. So Tata has acquired the Jaguar Land Rover worth rupees 9,200 crore on 26 March 2008. And all the transaction was done in cash. Now, business alliance are what? Business alliance is the process in which the companies they come with their expertise. Okay, they make partners, they work for a certain period of time, and when they have achieved their goals, when they have achieved their objective, now they will move back to their own work. So this is the example of joint ventures when company they come and work in jointly. Strategic alliance when companies they come with their expertise, with when they come with their own resources, licensing, franchising, all are the example of business alliance. Okay, so some of the examples are like General Motors and Toyota formed a joint venture in 1980. Merck has over 100 partners in R&D. The IBM formed a partnership with companies like Cisco and Dell, and Oracle has 15,000 business alliances. Next is the five sins of acquisition. So, what are the five sins of acquisition? What are the failure that the acquisition may face? So, there should be presumption of failure because so many mergers fail because what they claim they could not do it. So, there are many companies they claim big things, but in actual they do nothing. So, that is why they have to suffer a lot of failure in their life. So, five sins of acquisition is what getting way too far away from it. You are going so you have gone so far that you cannot come back. You are showing that, see, I have acquired this company, that company. So you are showing, okay, you are for showing others you are doing the acquisition. Then you have indulged in the activity so much that you, without thinking, and you are getting failures in that. So you have indulged in the acquisition process so much without thinking that you are regretting. Overpaying, you have paid more amount to the target company than the actually it was. And inability to integrate well after acquisition. Now the acquiring company is regretting, acquiring company is not able to integrate well with the target company. So this is also one of the five reasons of acquisition. Now, next is what? Next is the divestitures. Divestitures is what? When an entire company, from this entire company, when the company sells a part of their company or the division of their company, this is known as the divestitures. Now, this can be done partial also, full also means entire company is being sold or a part of the company is being sold. That is known as divestitures. Okay, why company they do divestitures? There are many reasons, like the company is not able to focus on their all the departments, all the functions, all the head. That is why the company has sold some of their part. It is possible that division of business contribution total income are insufficient, means when particular division or particular department is not giving you more income, they have become dormant, then that is the reason you have sold this department. The size of the company is very large, employees are very less, you cannot manage the company, that is why you have sold the division of the company. Or if the company needs immediate need of funds are there, if the company need immediate cash, then also the company sell the division or part of their company. Now different forms are there. Either the company will sell the complete entire company or company will sell a portion of their assets. Spin-off is what? In this from entire company, one independent company is created. One independent company is created, and in this and the shareholders of the existing company means the parent company. This is existing company. One company is created and that company is working in an independent way. So the shareholders of the parent company, existing company, they will get the shares in the new company. Split up is what? In this only one independent company is formed. In spin-off, in split up, many independent companies are formed. Many number of independent companies are formed. Many independent companies are formed, and the parent company is completely shut down. Here, parent company is not shut down. Parent company is also working. Independent company is also there. In split up, the parent company is shut down, and many independent companies are there. Equity carve out means in this, see, equity carve out, what it says, suppose I am the investor. I have invested in any company. If I'm investing in companies, I'm hoping now that the company will give me the ownership. Okay. So, but this company has not given the ownership its own company. The company is giving the ownership of its subsidiary company. It means the subsidiary company shares are given to the normal public, to the investors for the IPO. So that is equity carve out. So it is similar to spin off. Some shares of the new firm. New firm means the subsidiary company are sold in the market by making a public offer. So in this, the shares are not given of the parent company, it is given of the subsidiary company. Demerger of two family-owned business. Family-owned business, when the family-owned business is demerging, means making different independent companies like Reliance. Okay, Reliance has the Reliance Trend also. Reliance has the jewels also. Okay, Reliance has one division, Smart Point also. Then Reliance Digital also. So these are what? These are the different sectors. Okay, that they are dealing in different sectors. Like Reliance Trends is dealing in garments, jewels are dealing in jewelry, Smart Point, the grocery item, digital, the home appliances. So demerger of one family business into different divisions. Partial sell off means the half of the or a division of the company is entirely sold off as a slump sale. Slump sale means the entire component is sold. Not each and every component is sold, entire company is sold to another company. So it is like selling the whole shop, not individual items. So slump sale is what? In which the company sells an entire business unit, not an individual item, but the whole item. Spin off, parent company stays, and in split up, parent company ends. So one independent company is created in spin off, and in split up, many independent companies are created. Okay, so demerger, that is spin of new independent companies created, and the shareholders they get shares in both the company. So it means parent companies still exist and the new company is also there. That is in spin-off. So independent company, only one independent company is formed. In demerger, shareholders they exchange the original company shares into the new. So in demerger, in spin-off, what happens? The split of what happens? Many companies are formed, and the shareholders of the existing companies they have lost their existence in the old company. And carve out we have done just now. When the investors they get the shares of the subsidiary company, not the main company. Now, next chapter is all about the deal structuring. So deal structuring means what? Once you have done the acquisition, once you have done the merger, now it's high time you have to decide how the deal should be finalized. What should be the proper deal, whether all the amount is paid in cash or the company is taken with the help of cash and stocks or all the shares are given to the company. So what is happening? What is the final deal? So for final deal, there are different tax reliefs and benefits that are given in case of amalgamation in India. When the amalgamation is done in India, then only the tax reliefs and benefits are given. What is that benefit? So company A and B, two companies are there. Company A is merging into company B. So when company A is merging into company B, so A is the amalgamating company, and the new company that is created is the amalgamated company. So one who is merging, when companies they are coming together, that is amalgamating, and when a new company is created, a new entity is created, it becomes the amalgamated company. So amalgamated company is a new company, and amalgamating company is the old company. So what are the tax relief given? So if an amalgamation takes place within the meaning of section 2, subsection 1B of the Income Tax 1981, so following tax reliefs and benefits are available. One is tax relief to the amalgamating company. So they are exempted from the capital gains, section 47, subsection 6. So in this, the companies, the amalgamating company means the old company is getting the tax relief. All right. So when one company transfers its all the assets to another company in the new company, then this transfer is treated as capital gain in normal scenario. But in under section 47 subsection 6, no capital gain tax will be charged on this transfer if the transfer is made as a part of genuine amalgamation. Then next is allotment of shares are given in amalgamated company under section 47 subsection 7 and 49 subsection 2. So when the old company merges into the new one, the shareholders of the old company they get shares of the new company in exchange for their old shares. Under section 47 subsection 7, this exchange is not treated as sale, so no capital gain tax will going to apply. Same for the same scenario for section 49 subsection 2, when shareholders they sell their new shares in the future. When the shareholders when they will sell their new shares in the future, then their cost of acquisition will be considered as the same cost at the value that they have bought the old shares. So cost of the old shares. So again, this will not be considered as the capital gain taxes. Then certain tax relief are given to the amalgamating company, exemption from capital gains. So again, this is not considered as a taxable transfer, so no capital gain is there. And some of the tax relief is given to the new company that is amalgamated company. What is that is they get the benefit of carry forward and set off of all unaccumulated losses and unabsorbed depreciation under section 72A. Means if the old company has made any kind of loss, and if old company is merging into a new company, old company has merged into a new company, then that new company will get the benefit of carry forward. They can carry forward all the losses of the old company and they can set off all the accumulated loss. It is included in section 72A, but again, certain conditions have to be followed. What are the conditions? Section 72A of the Income Tax Act 1961, it deals with the mergers of the sick companies with healthy companies. And to take advantage of the carry forward, the following conditions are to be fulfilled. The company should be including the company should own a industrial undertaking. The company should be referred and in sections 5C of the Banking Regulation Act. So the company should be a banking company referred under section 5 subsection C. One or more public sector company should engage in the business of aircraft with another public sector company, or if it should be the specified bank like SBI who should work under, with that bank should work under SBI Act. So these are the conditions. If these are the conditions that are followed, then only the company will get the benefit of carry forward and set off of accumulated losses. Accumulated losses means all the previous year losses will be accumulated. And the amalgamated company should be an Indian company. All right, so amalgamated company should be an Indian company. Now, the amalgamated company should have engaged in the business for 3 years or more, means if the amalgamated new company should have engaged for 3 years, the new company should have taken at least three-fourths of the book profit. Three-fourths means 75% of the fixed asset the new company should have taken of the old company for a minimum period of 5 years. Then the new company should have used the old company's machine up to the production level of at least 50%. The new company amalgamated means what? The new company should have submit the form of AO, a certificate form 62, and it should be verified by an accountant. So that should be electronically. It should be fulfilled that all these conditions are being fulfilled. That is why the form has to be form has to be filled. All right, so these are all the terms and conditions of the amalgamated and amalgamating company so that they can get the tax benefit. Now, next is all about the inbound and outbound acquisition. What is inbound and outbound acquisition? Inbound acquisition means when, see, international acquirer purchases the shares of a target company. Inbound acquisition means who the acquiring company is of the, okay, acquirer is of the foreign company is the acquirer and the target company is of the India. That is inbound means the company is coming inside to acquire the Indian company. Remember in this way. So inbound acquisition means international acquirer is purchasing the shares of the Indian company shares and Indian company is what target company. So this is known as the inbound acquisition. So this is foreign company. Foreign company is making one FOCC, foreign owned controlling authority, and with that FOCC, the foreign country is acquiring the target company that is situated in India. Foreign owned and controlled companies. Now, one next is what? Next is all about the outbound acquisition. Outbound acquisition means the acquirer is of India and the target company is of the foreign means Indian acquirer is acquiring the foreign company, then it becomes the outbound acquisition. So inbound acquisition is what when the foreign acquirer is acquiring means foreign person is acquiring the Indian company, that is the inbound acquisition. And when Indian individual is acquiring the foreign company becomes a target company and Indian individual is the acquirer. So that is known as the outbound acquisition. Okay. When inbound acquisition is happening, when the foreign company is acquiring the Indian company, then in that case, the Indian bank will not going to provide any kind of help. How the foreign company will going to arrange funds? So foreign company will going to arrange funds from APLMA and LMA. So LMA and APLMA will provide the funds to the foreign company so that they can acquire our Indian company. And if the foreign company is acquiring the Indian company, so it becomes difficult to acquire. Why? Because the foreign company has their separate rules and regulation. Indian company has separate rules and regulation. So what foreign company has used their brain? Foreign company will make one FOCC. FOCC is just like SPAC. So a SPAC company is created specifically a company is created in India. So FOCC will be incorporated in India only. If this company is incorporated in India, it means this company has followed the Indian rules regulations. So now it becomes easy for the foreign acquirer to do the acquisition process in India. That is why the foreign acquirer will use FOCC. Outbound acquisition. So again, this is the what? This is Indian company. Indian company is the acquirer. Indian company is acquiring the foreign company or the subsidiary company. So in this case, the Indian banks will provide funds to the Indian company. Alright, so an Indian incorporated subsidiary or Indian company will acquire a foreign company with the help of special purpose vehicle with the help of special purpose entity. So in that case, the Indian bank will give the money. See, it's obvious now. Indian bank will help the Indian company to do the acquisition of foreign company. But why would the Indian bank will provide the foreign acquirer to acquire the India company? It's not happening. So who will provide the money to the foreign companies? LMA and APLMA. And inbound acquisition, offshore acquirer will establish a special purpose vehicle outside of India, known as FDI, SPV, or FOCC. Through FOCC, the inbound acquirer or the foreign acquirer will purchase the Indian company. Outbound acquisition. So how the Indian will purchase a foreign company with the help of Indian company will raise loan from the Indian banks, or Indian company will take the help from ECB, that is external commercial borrowing. So if India is having any kind of subsidiary in foreign country, then ECB will provide loan in that case. All right, so this is all about the inbound and outbound acquisition. Any doubt to anyone? Yes, it's done. I hope everything is clear to you so far. Just wait for 1 minute. Okay, now let's start our another part. I hope audibility is okay. Okay, so let's start with the questions. Okay, now it's quiz time. So, okay, so round about 35 questions are there in all the modules. In some modules, 35 question, in some modules, 30 question we will be having. So now let's do all the questions. Now, question number one. According to Henry, fuel management involves which of the following set of activities? See, normal there are five functions of management: planning, organizing, staffing, directing, and controlling. But Henry Fuel has given these functions of management in a bit different name. Now, what is that? The planning, organizing, commanding, controlling, and coordinating. So, coordinating and controlling. So, these are the five functions of management given by Henry Fuel. Now, second. Question number two, what it says, a senior operation manager at a multinational conglomerate operating under a deeply entrenched classical administrative mindset. Classical administrative mindset means that is the work should be done with the help of technology, updated technology should be used. That is what the traditional method says. And the multinational companies are operating in a conglomerate in a different types of business. It also the workforce is very inherently indolent, creatively bankrupt, fundamentally incapable of exercising. So the workforce means the people who are working in the company, they are very lazy, they are very dormant, they are bankrupt sort of person, they are incapable of taking their independent decisions also. And these people, they need more self-regulation, they need more supervision on themselves. So consequently, the manager has used the stringent oversight for handling these employees. Okay, high strict compliances are there. Then micro surveillance is there. Organization control is also high so that the productivity can be made. The productivity should be high. All these are the things a manager has included for making their employees work better. So this manager disposition and its underlying assumption framework is related to which type of theory, which approach it is this. This is talking which approach, Y, Z, X, or Herzberg's motivation theory. So theory X, we don't have to study in your syllabus. All the theory X is given by Auchi. Okay, Auchi has given this theory X, this theory Z. Only two theories you have to study X and Y. So theory X says the about the dormant employees who dislike to work, who lack self motivation, who lack self determination. So this entire scenario is talking about theory X. On the other hand, theory Y is the type of employees who always like to work, who are self determined, who are ambitious, who always take responsibility. So they are theory Y. So option C. Now, who is known for the 14 principles of management, which includes the division of work, unity of command, and scalar chain? 14 principles of management given by whom? So 14 principles of management given by Henry Fayol. So Henry Fayol has given the 14 principles of management. The first is division of work, means work should be divided into small and manageable activities so that it becomes easy for everyone to handle. There should be authority and responsibility. Authority means right to give orders, and responsibility means obligation. Discipline means the work should be done in a proper discipline. There should be unity of command, means one person should receive order from only one superior. Direction means everyone should move in the same direction. Subordination of individual interest means the company should see what the people are saying, and then the individual goals should not be achieved, the group goals should be achieved. Remuneration, fair remuneration should be there. Centralization and decentralization means centralization means the authority making power lies with the top person. Decentralization means the right to make decisions is distributed among different people. Scalar chain means that is the chain of command has to be followed. Order means that everything should be followed in the systematic manner. Equity means all about equality. There should be the equality between men and women. There should be the equality between the remuneration of men and women. Stability of personnel means that you should provide security to your employees if they are working in the company. Initiative means how much your employees are initiative to take decisions for the company. And Esprit de corps means that is the teamwork. So the individual should work in team. So these are all the 14 functions of management. Next, question number 4. A manufacturing company adopts Deming's TQM. CEO says we must build quality into the process rather than inspect. So CEO says that we should not wait for the inspection period. If we know that the quality is lacking, we should work instantly on that. So it says which principle? 1639. So it says stop depending on inspection, that is principle 3. So that is stop depending on inspection, principle 3. Next. What does the acronym SMART stands for? Very, very important. So SMART means specific, measurable, achievable, relevant, and in timely manner. Timely means in time bound manner. So specific, measurable, achievable, relevant, time bound. Next. So newly appointed general manager has newly appointed at a regional bank, and he notices that assistant manager reports to three different senior managers simultaneously. Who are those three different? Credit head, operation head, compliance head. All of them, they are giving different instruction to this assistant manager. Now this assistant manager is quite confused that which to whom this person will follow. So which principle of organizing is being violated over here? So which principle? See, it is being said that the one person should receive order from only one superior, not from many superior. But here are three different senior managers. So which principle is being violated? Specialization, unity of command, span of control, or continuity. So unity of command is being violated over here. Unity of command says that one person should receive order from only one senior person, not many senior person. Now, case study. Priya is the new appointed operations director at Mid City Bank. She finds that bank has no clearly defined departments, and all the 22 employees ranging from IT staff to front desk officer to risk analyst, they all are reporting directly to her. Means Priya is managing 22 employees simultaneously. Simultaneously means at the same time. She is overwhelmed with that, but at the same time, the decisions are very slow. The employees, they don't know about their roles and responsibilities. The entire structure pattern of the company is disturbing. The functions, the functional departments, okay, it needs to restructure. So she decided to restructure the different departments like retail banking, risk compliance, IT, and HR. And all these departments they will have their head, they will have their senior person. So each department will have head, and that head will report her. Means from 22 employees, these employees are distributed in different departments, and now each department head will report her. So what is being done over here? It means the span of control is being reduced. Yes. So now she have to only oversee four department heads instead of 22 individuals. So where Priya was managing 22 individuals at the same time, now because the individuals are distributed in different departments, and these are the grouped according to their similar task, to their similar task. That is departmentalization. Departmentalization is this only now. So now the Priya will only oversee four departments. So which type of principle of management is being addressed over here? Continuity, unity of direction, scalar chain, or span of control. So that is principle of span of control. So one person is managing how many individuals in the company. That is what the span of control is. Now next, types of strategy. Corporate strategy, business strategy, and functional strategy. So corporate strategy, it is made by the top managers. It includes the overall direction of the organization. Business strategy, it focuses on the specific business, specific product, specific activity. So it is made by the middle level managers. And functional strategy focuses on different functional departments. So it is framed by the lower level managers. So corporate strategy, this strategy company covers overall direction followed by the company. It would spell out the general attitude of the company, how the company is growing, how the company is taking decision, how company is managing their rest of the department. So it's a part of corporate strategy. Business strategy, it is prepared at different levels of business unit or level of product service. So specific product, it caters specific product or specific market or specific industry, the business strategy caters. And functional strategy is it is divided on the basis of different functions like HR functions, marketing functions, operations functions. So this strategy refers to approach adopted by functional areas. So one, two, and three. Option T. Which of the following statement is true? So plan is an arrangement, a pattern, a program for a definite purpose. Yes, plan is what? Plan is fixed. It is for the definite purpose. It is very concrete. If you have made any plan, you will not change that plan. But the methods you will change, the ways you will change, the strategy you will change. So plan is the concrete. Yes. Strategy on the other hand, it is the blue out, how to achieve the plans, how the goals should be achieved, the idea of accomplishing a specific goal. It is very flexible. Yes, if one strategy is not working for the plan for achievement of objectives, you will design another strategy. So strategy is flexible, but plan is not flexible. It is fixed. It is static. Both the statements are correct. Next, a manufacturing company sets a goal to reduce its product defect rate by 20% within the next 6 months. So in next 6 months, the product defect rate has to be reduced by 20%. Management has communicated this to all their employees that we have to work on our product. The defect rates are very high. Now we have to work on this. After 3 months, the company has reviewed the performance and find that the product defect rate has only increased by 10%. Okay, so after half of the time period is over, the company has found that the product has decreased only 10%. Which step of controlling the company is currently in? Means what the standards have been set by the company and how much performance the company has done so far. That the this is what is being measured in the company, how much performance the company has done and what was the ultimate standard. So process of establishing goals and standard, no. Continuing to monitor the effects of corrective action, no. Comparing actual performance to the predetermined goal criteria, yes. This is the answer. Studies on leadership behavior conducted by 1950 by the whom Ohio State University and Chicago University. Two universities were there, and in these two universities, the study was conducted on the behavior of leader by the researchers. If in Ohio State University the consideration leader behavior was there, so what is in matching to this consideration leader behavior? What was the name that was studied under University of Chicago? So consideration leader behavior in this the in Ohio State University consideration means talking about the relationship between the people. So it is related to relation oriented behavior. Option B. See, consideration leader behavior matches with relation oriented behavior and initiating that works on the task, the planning, the operations, the activities. It focuses on the task oriented behavior. Next. Which aspect of planning is connected to the fact that planners typically have high level of intelligence? See, high level of intelligence the planners they have because they can talk about the ability, about the things that they want to change in the company by evaluating their surrounding, by forecasting their future, by measuring their pestle, outside, inside factors. So which option is most suitable in this case? Planning is an intellectual workout. Planning involves looking in future. Most important part of the management is planning or making choice is the integral part of planning. See, all the options are correct, but which one is most suitable? It says have a high level of intelligence because they keep talking about their ability. So, see, intelligence keyword, ability keyword to evaluate their surroundings, how to evaluate your surroundings when you know what is good and what is bad for the company. So, it means the planning is what? It is an intellectual workout. Option A. What is the correct sequence of management by objective? So, management by objective given by whom? Peter F. Drucker. And management by exception given by whom? That is Taylor, F.W. Taylor. So what is the correct sequence of management by objective? So first, what we do in management by objective? Okay, we need to either establish or alter the organizational goals. So first, we will establish the goals of the company, the objectives of the company. Once the goals are established, now you will ask from your employees, you will encourage your employees to participate in achievement of these goals. So three is then next you will communicate or you will encourage participation. So next participation is there. Okay, first you will communicate to their employees. Yes, first you will communicate to their employees that okay, these are the goals that are set by the company. You need to actively participate in this. So after communication, then you will ask them to participate. Once they have participated, then you will monitor their activities. Then you will track their process, what they have done so far. That is four. After that, you will find in this step, you will evaluate and then you will reward the employees. So three, then two, okay, communication, participation, monitoring, and then last is evaluating. So three, two, one, four, five. Three, two, one, three, two, one, four, five. Option D is the correct answer. Clear? Okay. Next. And it's high request from you all that please do subscribe the channel tomorrow you will be having final marathon session of BRBL. So for that, do subscribe the channel, like the session if you feel it is helpful to you, and don't forget to share it with others also. So Beta Electronics is implementing a learning organization. Learning organization is the process where people they learn together, they come together, they try to solve the managerial level problems. So different disciplines are there. 5 disciplines are there through which the learning organization is made effective so that the goals can be achieved. The company has successfully developed a shared vision, means the vision and mission, the targets of the company should be communicated well. Team learning initiatives means people should work in a collaborative manner. And during the strategic review meeting, it was observed that marketing department believes that sales declined. Why? Because the product quality was bad. Production department blames that it was done because we were not having sufficient budget to add the standardization in the products. Then finance department says that it is the problem occurred because of poor credit management, and HR department thinks that employee turnover has affected. Now from this scenario it is clear that the people they are playing a blame game. Yes, the system is not good. The entire internal system is not properly managed effectively. That is the one of the thing where the learning organization is lacking. So despite having skilled individuals, collaboration, the organization still fails to interconnect the nature of these problems. What is the primary reason for this? That is the mental model. No, people they know what is good, what is good and what is best for them, but still they are not following our system. Means the cross departmental activities are not managed effectively, properly, and which is affecting the entire organization. So the system thinking means inability to see how departmental actions are taking, how they are taking decisions, and they are not communicating well. That is the one of the reason that affects the entire organization. Clear? Next, a manufacturing company wants to evaluate a tool maker's job. After comparison with other benchmark jobs, they find that skills are similar to electrician, that is 5. Mental requirements is similar to welder, that is 10. Physical requirement is similar to electrician, 12 points are given. Working condition is similar to mechanist, that is 20. And responsibility is similar to mechanist, again 3. So what will be the wage rate for the tool maker using the factor comparison method? So different factors are there. What are the factors like skill, physical requirement, mental requirement, working condition? These are the factors, and these factors are same for all the level of employees. Okay, be it the middle level, be it the top level, these factors will be same. And on the basis of these factors, the comparison is done. Who is having the highest point, that person will be kept first. So, what is the wage rate? So, add all these, what answer getting? 15, 12, 27. So, that is 54. Option. Alright, so option B is the correct answer. Okay, so 5 disciplines of learning organization are what? That is personal mastery. Just now we have seen shared vision, mental models, team learning, and system thinking. Question number 17. Statement 1, 2, 3. Statement 1, what it says? Management by objective is a performance appraisal method where managers and employees they take decisions collaboratively. They take decisions for the company together. Yes, correct. The 360-degree appraisal methods gathers performance input only from an employee direct supervisor. No. If only it is coming, it means it's the wrong. The 360 degree, it includes not the feedback, not from only the senior manager or supervisor, but from all the different person, like your peer members, the outsiders, the managers, the supervisors, then customers, the clients, the networks, every one of them. And B, Bart's method assess employees based on specific behavior. Yes, how the person has behaved in the past on the critical incidents. Accordingly, that the his or her performance is measured. So 1 and 3 are correct. Next, question number 18. A startup wanted to know how many unit of products it need to sell to cover its cost. Using break-even analysis, it calculates the fixed cost, variable cost, and projected sales volume. So, which traditional controlling insight does break-even analysis? So, break-even point is the point where the company is making no profit, no loss. Yes, no profit, no loss. And break-even point, it says if the break-even point the company has achieved, it means the company has covered all its cost, its fixed cost also, its variable cost also. If company has achieved its break-even point very early, too early, it is healthy, the company is healthy in that case. So if all these break-even point, these are all these analyzed, these are calculated. So what insight the controlling technique talks about the break-even analysis? Indication of performance, bottleneck and employee inefficiencies? No. If the company has already covered its cost, the break-even point, so how inefficiency is there? After that, whatever the company will make, the company profit is there. The minimum sales volume required to avoid losses, adding pricing and production decision. Yes. The minimum sales volume that is needed to avoid losses means that is needed to cover your fixed cost. Once you have covered all the costs, now you are not making any kind of loss. If you are going above, so you are making the profit only. Like this is the break-even point. If you are moving, you have achieved at this position. So definitely you have achieved this position from the lower level only. After that, if you are moving high, so you will make only profit, not any kind of losses because you have already covered your cost. So the minimum sales volume that is required so that the losses can be avoided, the prices can be add on, and the production decisions can be taken. Well, next, question number 19. Manufacturing company sets goal to reduce the product defect rate by 20% within the next 6 months. Okay, I guess this is a repeated question. The management communicates this goal to all employees and emphasize. Again, the same question is this same type of question that the product defect rate was 20%. Okay, now the company wants to reduce the product defect rate was increasing, so company has decided to reduce it by 20%. And for this, the company has provided the information to all their employees, to all their people that we should work on product defect rate to decrease by 20%. But after the 3 months, it was tested that the product rate defect has decreased only by 10%. So which step of control process the company is currently working in? It means the company is comparing the actual performance with the standard one. So this is what the company has done, and this is the standard of the company. Standard means the estimated, the benchmark, the standard performance, the benchmark, or the estimated. All these are same. So which step of control process is the company actually in? That is comparing actual performance with the predetermined goals. All right, question number 20. Which of the following methods of performance appraisal is designed to provide feedback not only from supervisors but also from peer members, subordinates, and sometimes even external clients? So just now we have done that if the performance is measured, if your feedback is taken, so it is taken from all the people, not only from few people. So it's a part of 360-degree appraisal feedback. Option A. So here where the feedback is taken from the employees, from the peer members, from the clients, from the network, from the uh, customers, from other networks, from suppliers, from senior managers. So all the person will give the feedback, not only one or two people. What is outplacement recruitment? Outplacement recruitment means this is basically a type of recruitment when the people gets fired from the company. Then this type of recruitment will help those individuals, will help those employees to find a suitable job for them. So it's a method used by an organization to provide career counseling and job search support to those employees who have been displaced. What is the correct sequence of organizing? So first we will identify and divide the work, then departmentalization, all the tasks will be divided into the similar groups, duties will be assigned to them, and at last the reporting relationships, that who will report to whom. Option B. So these are all the process of organization: identification, division of work, departmentalization, assignment of duties, and establishing reporting relationship. Next, 23. So a bank prefers internal promotions to maintain morale but faces the stagnation. So bank is preferring to internal promotion. Okay, bank prefers that we will do the internal promotion of the employees first. But in that case, the bank is facing stagnation. Stagnation means no growth is there. No growth and lack of innovation is there. External hiring is very low and training programs are also outdated because company is searching the employees from their internal. Company is giving promotion to their internal individuals only. So internal recruitment may lead to inbreeding. Inbreeding means it is lacking. Okay, the manager of the company is choosing from their internal people only, that is inbreeding. Exclusive reliance on internal sources ensures adaptability. So if you are focusing more on internal sources, it will not ensure adaptability. It will lose your fresh comers who will bring new ideas to the company. Training deficiencies can amplify the skill obsolescence. So training deficiencies, yes, if the training deficiencies are there, so definitely the skill will also become obsolete. And external recruitment always reduces employee morale. It's not that the external recruitment will reduce the employee morale. If the external recruitment is done, so new pressures are coming, new ideas are coming into the company. So 1 and 3 are correct. Okay, so 1 and 3 are correct. Next, a manager uses performance linked incentives and strict monitoring. Why? Because so employee they can meet their targets, but at the same time they are showing low innovation and engagement. Why this so? What is the reason behind this? Because see, strict monitoring and performance linked incentives means the rewards and punishment. Yes, if employee will do the good job, reward is there. If employee will perform bad, then punishment is there. So this reflects which type of leadership. We have studied now 4 5 types of leadership. So it reflects the transactional. Transactional is what? That is give and take policy. It is also known as managerial leadership. Clear? So this is correct. Extrinsic reward always enhance intrinsic motivation. No, it's not that if you are giving extrinsic rewards, it will increase intrinsic motivation. Extrinsic reward will increase the extrinsic motivation, not intrinsic. And lack of innovation may indicate absence of transformational leadership. Yes, if there is no innovation, if there is no motivation, then it means transformational leadership is not available. This is correct. Motivation depends only on monetary incentives? No. Motivation depends upon the non-monetary incentives like recognition, acknowledgement, appraisal. These are the ways on which the motivation also depends. 1 and 3 are correct and 2 and 4 are wrong. If a manager makes, next question, if a manager makes a decision based solely on their own personal heroism or intuition, without supporting data, which principle of decision making are they violating? So there are 3 types of decision. One is the principle of definition, okay, principle of identity, principle of evidence. So it says if the company follows the fact and figures, if the company follows the proofs, okay, then if the company is taking the decision on the basis of fact, proofs, then the company is following the principle of evidence. But if the managers they are taking decisions on the basis of their intuition, on the basis of their preference, on the basis of their likes and dislikes, then it which kind of principle it is violating? The principle of evidence. Next, question number 26. A multinational pharmaceutical firm is experiencing a decline in sales. Okay, the sales are declined in a specific region, and regional manager attributes this to the poor sales team performance. So regional manager has said that the Sales team has not performed well. The performance was very poor. That is why the sales went down. However, after doing the analysis, it was clear that because of the regulations, shift in local consumer preference, alternatives, and a recent increase in the country's inflation rate, these are the reasons why the sales became down. Now, these are the reasons in which type of factor it will come in. We have two factors, na, internal and external. Internal factors are controllable and external factors are uncontrollable. So this is a type of pestle and pestle, and all these factors will come under pestle analysis, that is outsider factors. Statement 1, 2, 3, and 4. Statement 1 says on the job training, when the training is provided to you in your workplace only, that is known as on the job training. So employee learns by doing the actual work under supervision. Yes, employee learns by doing their actual job under the supervision of the person. Job rotation, apprenticeship are the example of off the job training. No, this is the example of on the job training, not off the job training. So it is incorrect because job rotation is what it is done in the company, it is done in the offices, in the where you are working. All right. Now, statement three, in off the job training, learning takes place in an artificial environment. Yes, in off the job training, like vestibule training is there, simulator training is there. So it is provided in the outside the job location and it takes place in the artificial environment, correct? Vestibule training, classroom lectures are the example of off the job training. Yes, this is also correct. So only two is wrong. 1, 3, and 4 are correct. Option B. Clear? Now, next. Question number 28. A manufacturing firm experiences declining employee engagement despite they having a strong process efficiency. So a manufacturing firm experiences what that the employee they are engaging very less even though their process are efficient but still they are not engaging much. Now the leadership also introduce informal communication, okay, team-based incentives and behavioral intervention so that their morale can be improved, they can perform well. Okay. Simultaneously, productivity begins to rise even without major changes in technical process. Which intellectual tradition most plausibly underlies the shift in managerial approach? Shift in managerial approach. So, which type of school of thought it is talking about? See, this theory basically it says that the new classical, yes, new classical theory, what we have seen that it focuses on making good and healthy relations among the people, the motivation level, the psychological aspect. So, if the manufacturing, although the engagement is declining, still the leadership it introduces the informal communication, team-based incentives, behavioral intervention, so that their morale can be improved. So the team is doing what team is working on the new classical approach. It means focusing on human behavior, motivation within organization. Next, a senior executive emphasizes that managerial effectiveness lies in designing work methods scientifically, ensuring that tasks are executed. Again, a senior level executive has emphasized that the effectiveness lies in designing work in a more scientific manner. Okay, here one keyword is there that is scientific. Now, in which school of thought we have read this, the scientific? Scientific method means the new methods, the new technology. So where we have read this, that is in the classical and traditional school of approach. Yes, in this we have studied that the company should focus more on the technology so that the efficiency can be increased, effectiveness can be increased. And this philosophy prioritizes the precision more on the standardization and economic efficiency over behavioral consideration. So it talks about what the scientific methods should be used in the company. That is scientific structuring of work progress. Question number 30. Consider the following statements regarding foundational management theory. So framework emphasizes that employees they have to work towards the employees who are reluctant towards the work. They advocate strict supervision. Yes, if they are not working properly, then the close supervision is required in them. Organization productivity improves the social interaction. Correct. The proposition that management is the collection of diverse roles challenges the idea of being purely scientific or formulation of bureaucratic structures prioritizes flexibility. See, in the first statement, it says that the if employers are not focusing on their work, okay, they need close supervision, a strict supervision, correct? Organization productivity, if how to improve the productivity when the employees are motivated, when there is good relations among people, when social interaction are high, then only the organization productivity will also increase. This is also correct. Third, it says the proposition that management is collection of diverse role challenges. See, management is a collection of diverse role means management are performing different role and these roles are being challenged by how the people are working in the organization. So their idea is purely based on the scientific methods. This is also correct. But in this last statement, it says the bureaucratic forms flexibility. No, bureaucratic forms of fixed hierarchy, not flexibility. This is wrong. So only 1, 2, and 3 are correct. All right, so this is all about this. Question number 31. A multinational organization restructures its decision-making framework such that senior leadership intervenes only when performance deviates. So multinational organization is working on the making decision making more better, restructuring its decision making. Why? Because senior leadership is only interfering only in the case when the things get violated, when the things are deviated. They are not focusing on the all the activities of the company. They are only focusing when the things go bad in the company. Routine operational decisions are delegated downwards. So routine operational decisions they are handed to the low level people. They can handle it well. While the strategic oversight remains centralized. Over time, top management focuses on long-term direction rather than operational noise. Now, which type of managerial logic best explains over here? What it says, it says that this particular statement is following MBE. Yes, MB, this is following MB. What MB says that it says that the manager need not to focus on all the activities of the company. Manager should only focus on their core activities. Rest of the activities, their low level people can handle it well. Yes, this is all about MB. So concentration on deviations rather than routine operations. So if the work is deviated, if the deviation is there, then more concentration should be there, not on the routine task. Consider the following statements regarding managerial functions and process. Planning precedes organizing. Yes, planning comes before organizing. It gives direction also for all the activities. Organizing involves structuring. Yes, organizing means structuring. Okay, putting the people, assigning the roles to them, assigning responsibilities. Controlling focuses solely on setting objectives. Is it so? Controlling focuses solely? No, controlling focuses on all the activities of the organization, whether it is planning, organizing, staffing, directing, not on the planning process only. And leading includes motivating and guiding. Yes, this is also correct. Only statement 3 is wrong. 1, 2, and 4 are correct. Option A. Next. A company evaluates its internal capabilities and external environment. It identified that outdated infrastructures are limiting the factor. Limiting factor means they are not helping the company to grow, they are limiting the company from the growth and expansion. While some patterns have been recognized that technological advancements are high, these have been emerged and these are the potential for the expansion of the company. So two things are there. One is it is talking all about the outdated infrastructure means the weakness of the company, and second is advancement, technological advancements. These are the expansion for the company. These are the hint given for the expansion of the company means the opportunity. So what it is talking about weakness and opportunity of the company. And in SWOT analysis, remember S and W stands for the internal factor and ONT it indicates the external factor. Option B. Consider the following statements regarding planning. Identification of objectives precedes evaluation of alternative courses of action. Yes, first you will identify the objectives, then you will evaluate the alternative course of action. So this will come first, this will come later. Selecting among alternatives occurs after assessing feasibility and implementation. Yes, once you know that okay, this is the thing that will work in my company, then only you will select the options among that, among the all different options, you will select the best one. Premises development relates to assumptions. Yes, planning premises means these are the assumptions that are made by the company so that the future course of action could be done well. So different premises are there. Like the you will see the cost, the sales, the all the break-even point, the ROI, ROE of the company. So on the basis of all these factors, the qualitative, the quantitative factors, you will make the best decision for the company. And budget formulation precedes the establishment of objectives. So budget formulation, it precedes the establishment of objectives, or once you have decided the objective, after that you will set the budget. That whatever your objectives are, that you will state, and after that you will decide the budget that okay, in for achieving this objective, this much budget is required in this department, this much budget is required in marketing department. So it is not preceded, it is succeeded. So this is wrong. 1, 2, and 3 are correct. Now, next question number 35. A company revises salary structures, improves workplace conditions, and then strengthen the supervision quality. So companies revising, companies doing the revisions on their salary structure, giving more salary to their employees, improving the workplace condition, and also strengthening the quality of the supervision. While some employees their dissatisfaction reduces, some employees dissatisfaction reduces, but in some employees there is no improvement in motivation or performance level. Some employees the dissatisfaction is reduces, but motivation is not increased in this. So management has introduced for motivation management has introduced role enrichment and recognition system and growth opportunity leading to a noticeable performance improvement. So for increasing the motivation pattern, uh, the company has included the growth opportunities leading to noticeable performance that certain improvements we will do, then we can improve the motivation level among employees. So which interpretation most accurately explains the observed outcome? See, it says that there are different factors that provide the satisfaction, also dissatisfaction. So we have seen in the Herzberg theory that two factors are there. One is the motivating factors and one is the hygiene factors. If motivating factors these are present, it will create satisfaction among employees. In hygiene factors, if these are absent, these will create dissatisfaction among employees. So external rewards alone determine employee motivation low. Elimination of dissatisfaction automatically ensures high motivation. Yes, if dissatisfaction is eliminated, then again the motivation level will increase high. Wait. Just a minute. Okay, so in hygiene factors, two are there motivation and the Herzberg has given two factors. One is motivation and one is hygiene. Motivation, what it says, motivation says that if motivating factors are present in the company, what it will do, it will satisfy the employee. And if hygiene factors are absent in the company, so it will give the dissatisfaction. So it says the elimination of dissatisfaction. If dissatisfaction is eliminated, it means what? It will automatically ensure high motivation. See, dissatisfaction and satisfaction, this is like two sides of the coin. Motivation talks about the satisfaction level and hygiene talks about the dissatisfaction. But it says that if this is removed, then this will be motivated. No, it is not correct. It says that both are having distinct factors that govern the dissatisfaction and true motivation. So dissatisfaction comes from different factor and satisfaction comes from the different factor. So this one will be the correct answer. Option C. Clear? Done? Any doubt? We have completed module A. Any doubt to anyone? Just wait for 1 minute. All right. Now, next. So we have completed total till 35 questions in module A. Now let's start with module B. Okay, 36 to 72 questions are there. Now, first question number 36. What it says, a company will pay a dividend of rupees 5 1 year from now. 1 year from now means D1 is given. If D1 is not given, DO is there in the question. How to calculate D1? If DO is given in the question, how to calculate D1? That is DO into 1 plus growth. This is the formula. Okay, D1 is already given. Then growth rate is given 10%. Investors required rate of return KE is given 14. You have to find the fair market price of what is the fair price of the stock in today's term. So PO, how to calculate PO? That is the price of the share. That is D1 upon KE minus D. D1 is 5. KE is how much? KE is required rate of return, that is either KE you can write or R, both are same. So KE is 0.14. I can write 14% as 0.14. Yes, minus growth is 0.10. So 5 upon 5 divided by 0.04, that is 125. So 5 upon 0.04, it means the fair price of the stock is rupees 125. Option B. Next, question number 37. Which statement is incorrect? You have to find the incorrect. So higher break-even point indicates firm with high leverage. Higher break-even point means high leverage is there. The firm is taking high leverage. High leverage indicates high leverage means high debt is there. So higher break-even point, more break-even point means more debt the company has taken. Lower break-even point indicates the low leverage the company has taken. And lower fixed cost indicates high degree of operating leverage. So lower fixed cost, if the fixed cost is lower, then it will indicate lower operating leverage. Now, operating leverage is what? Operating leverage, it arises due to the presence of fixed operating cost. Fixed operating cost. So if fixed operating cost means the salary, the rent, these are what? These are the fixed operating costs. So if fixed cost, if degree of operating leverage is high or if the fixed cost is lower, it will not indicate high degree of operating leverage. So lower fixed cost means low degree of operating leverage and high fixed cost, it will indicate high degree of operating leverage. The firm has taken high fixed cost means high operating leverage is there. Clear? So which option is incorrect? That is option C. Okay, higher break-even point means that is the high fixed cost, high leverage, high risk means firm need more sales to earn the profit. Okay, higher break-even point. Higher break-even point means you are achieving the break-even position very late. Means you have to incur more amount in order to achieve your break-even position. So for that you need to take high leverage, then only you can lower down your break-even point. Answer C. Next, question number 38. So statement 1, statement 2, statement 3. Internal accrual arise out of profit after tax and non-cash profit charged to the PL account. Yes, internal accrual is what? After giving, see, sales from sales, you will deduct variable cost, you will get contribution. Into contribution, you will deduct the fixed cost, you will get EBIT. From EBIT, you will deduct interest, get EBT. From EBT, you will deduct taxes, you will get EBEAT or PAT. Now, this is the profit after tax. This is the profit that either you will distribute to your shareholders or you will keep as retained earnings. So, the retained earnings, the capital reserves, the retained profits, these are what? These are the internal accruals only. So, these arises out of profit after tax, correct? These are non-cash profit, yes, and these are charged to the profit and loss account. Use of internal accruals changes the ownership structure? No. With the internal accrual, no ownership structure is changed in the company. The ownership structure, what the company has decided from the initial level, the same it will be. No changes will be there. And there is no extra cost incurred in raising internal accruals, yes, because these are the profit of your company, these are the extra profit, the extra buffer or the EBIT that the company has made before the see the profit after tax means you have already paid the taxes, then you have got this profit. Already paid the taxes means you have already set all the obligation also, you have paid the interest also, you have set off the debt also. This profit is now left in the company and this will be distributed to the shareholders or you will going to keep it as retained earnings. So that is internal accruals are just your retained earnings. So both are correct. 1 and 3 are correct. Next question number 39. Preference shareholders, they have preference over equity regarding dividends. Yes, preference shareholders, they get the preference from the equity shareholders from the common stock. Preference shareholders, these shares, they always provide shareholders full voting. No, they don't get no voting right is given to preference shareholders. This is wrong. And participating preference shares, they allow holders to share in additional profit beyond the fixed rate. Yes, with along with the dividend, if the participating preference shareholders are there, so they are allowed to have the additional profits. Okay, they are allowed in the liquidation value, they are allowed in the extra bonus of the firm. Option B. Next, assertion and reasoning. So activity-based costing means activity means for each and every activity, it is having their own cost. If company is making any product, that product has to go through different activity, different stages. Every stage has their own cost. So ABC costing provides more accurate product costing, yes, compared to the traditional methods that includes in diverse products. Yes, this is correct. It assigns all the overhead costs, factory costs to product based on their actual consumption of activity rather than using one single cost in the entire company rather than using a single plant-wide overhead cost. Yes, both are correct. So activity-based costing is the costing in this all the every stage of the costing is accumulated to find out the total cost of the product rather than using one single cost like in raw material if you are saying that okay while making the goods of 10,000 units of good you need 50,000 units of raw material. Okay, let's take it not 10,000, 1 lakh. Okay, by making 1 lakh units, you need 50,000 units of raw material. So it doesn't matter that every time you are making 1 lakh, so you will get 50,000 units. So it may fluctuate also depending upon the market, depending upon the quality of the product. It says using the single plant-wide overhead rate of the based on the volume. So it is not correct. ABC overhead, it uses different stages of costing. Both are correct and the reasoning is also correct. Here, if you will read, activity-based costing provides more accurate product costing compared to traditional costing because ABC assigns overhead cost to product based on their actual expenses, based on their actual consumption of the activities. So both are correct and R is the correct explanation of A. Clear? Done? Now next, question number 41. You have applied the NPV method to analyze the feasibility of the project, whether the project is feasible or not, whether the project will give you good returns or not, involving huge cash flow. The GDP growth rate is falling in the country, and AI is also disrupting the entire traditional business. Next, hence your boss has asked you to build the adjustment of the risk and uncertainty. Okay, adjust your risk and uncertainty on the basis of the analysis. Okay, in the calculation, what type of analysis you will use to adjust your risk and uncertainties. So he want you to build in assuming all the variables they are moving in the same direction at the same time. So this is the biggest keyword, assuming all the variables move in the same direction. See, we know that in sensitivity only one variable is changed. So definitely this would not be the answer. It says adjustment of risk and uncertainty, assuming all variables move in the same direction. In Hillier model, what we have seen? In Hillier model, we have seen that the risk is analyzed, risk is measured with the help of standard deviation. So there are even and uneven cash inflows. Yes, this is also deducted. Now, what is left? Simulation and scenario. It says all the variables are moving in the same direction at the same time. So in simulation analysis, you test multiple of variables with the help of AI. But in this case, all the variables, they don't move in the same direction. This is only in the case of scenario analysis, in best scenario, in worst scenario, and in average scenario. So you are estimating that the variables, multiple variables are tested simultaneously and they move in the same direction. And then you are analyzing that which, if everything is good, means all the things are good, it is moving in the same direction, means in best everything is good according to you, no fluctuation is there. In worst, everything is bad according to you, and in average, everything is normal according to you. So this is done in the case of scenario analysis. Okay, we assume multiple variables are changed together simultaneously. So different scenarios best. Base case means the normal one and worst is the pessimistic. Next, a company sells 1250 units of shirts at rupees 200 per unit, having variable cost of 100 per unit and fixed cost of 50,000. What is the degree of operating leverage? So what is the formula of operating leverage? Contribution upon EBIT. Yes, so for this you need to calculate contribution. How contribution and calculate it? What is the sales? Sales is given 1250 into and units of shirts, and one unit of shirt cost rupees 200. So total sales are how much? So 2,50,000 minus variable cost is how much? Variable cost is 100. So 125000. So it is 125000. Sales minus variable cost, that is contribution. Contribution minus fixed cost is 50,000. 50,000 deducted, so it will come 70,000. That is what? EBIT. Now contribution is how much? 125,000. EBIT is how much? 75,000. So 125,000, 75,000, that is 1.66. So 1.67 we can. Clear? Done? Any doubt in this question? All right. Now next question is, that is, this was the question number 42. Next is, okay, this is the explanation given to you, 1.67. Next, question number 43. From the below given options, select the most appropriate characteristic shared by private equity and venture capital. What is the characteristics of PE and venture capital? So private equity, they provide funds in a more established business, and venture capital, they provide funds in a more early stage of business, seed level financing they provide. So both prefer to invest in established business? No. PE prefer to invest in established business. Both undertake a role of guarantor of the loan. No, this is entirely guarantor of different statement. It says both invest in business that are either unable or not yet readiness to raise finances. Yes. So if the company is not able to raise funds through IPO or through any bonds by issuing any bonds or security, so in that case, the private equity and venture capital will help the companies. All right, done. Now, next question number 44. So company A of India is evaluating a project in UK. Company A is of the Indian companies and this company is evaluating project in UK. Risk-free discount rates in UK and India are 6% and 9%. Okay. Risk-free discount rate of USA is given how much? 6%. Risk-free discount rate of India is given how much? India is given 9%. Risk-adjusted discount rate. So 1R is a risk-adjusted discount rate of India is given how much? That is 11%. So now we can write 6% as 0.6, 9% 0.09, and 11% 0.12. Okay, so what is the risk adjusted now? Risk adjusted discount rate of UK we have to find. So what is the formula for this? See, risk adjusted discount rate USA is given, risk free discount rate of US and India is given. We have to calculate the risk adjusted discount rate of the UK. Now risk adjusted discount rate of India is given. So with the help of Indian we can find the risk adjusted discount rate of UK. Yes. So what is the formula? 1 plus RF is equal to 1. 1 plus RA is equal to 1 plus RF into 1 plus C. This is the risk free discount rate USA, and one we have to find RA risk adjusted discount rate. Okay, sometimes in the question you will not given the risk adjusted discount rate also. So first you will calculate the risk adjusted discount rate of India and then you will use that risk adjusted discount rate of India in the US term. So 1 plus RF plus 1 plus RP. So what is given? RA is given risk adjusted discount rate. So we will calculate of India. 1 plus RA is how much? RA is 0.11 is equal to 1 plus RF is what? 1 plus 0.06. Okay. Into is this 1 plus RP. So 1 plus RP is not given. Not given. So first we will calculate RP. Whatever value will come, then again we will put the value and we will calculate the risk adjusted discount rate in UK. So this is 1.11 is equal to this is 1.06 into 1 plus RP. Yes. Now 1 plus RP is how much? That is 1.11 divided by 1.06. How much it is coming? 1.11. A minute. Okay, okay. This is UK, na? I have written USA. It is UK. UK it is 6%. India it is 9%. Okay, this one is 9%. India is 9%. This is 9%. So 1.11 divided by 1.09, it is how much? 1.018. 1.01834. 834. This we have got 1 plus RP. 1 plus RP that is 1 point. Wait, I guess it's not visible to you. Okay, so we have got 1 plus RP. Yes. Now this 1 plus RP can we apply this 1 plus RP in the finding the value of risk adjusted discount rate of UK? All right. Now next again in next phase what we will do? Again the same formula we will write. That is now 1 plus RA is equal to 1 plus RF into 1 plus RP. Now we are finding the risk adjusted discount rate of UK. It's not US. I'm writing every time UK. It's UK. 1 plus RA, how much? This we have to calculate 1 plus RF. So now we will take the Risk-free interest rate of UK, this is 6%. Now we will take 6%, 1 plus 0.06 into 1 plus RP. Just now we have calculated that is 1.01834. Yes, can we write this 1.01834? Yes. So 1 plus RA is equal to 1.06 into 1.01834. So 1 plus RA is equal to what it will come? 1.06 into 1.01834. It is coming 1.0794. So RA is equal to 1.0794 minus 1. It is 0.794 into 100 if you will do, because you have to find the answer in percentage. So it will come round about 7.94%. So this is the answer of risk adjusted discount rate of UK. All right, understood this question how to calculate. So company has evaluated risk-free. First, write what are the things given in the, okay, always write the things what are given in the question. Then plot each and every value in the respective formula. So this is the answer 7.94%. All right, 7.94%. Next, question number 45. Now let me turn on the camera. Change in any one of the factor of cost, volume, profit analysis, that is the cost, volume and price, it may result in changing what? If you are changing any one of the factor, either the cost, either the volume or the price of the product, it will result in change in break-even point also, payback period also. If you will add more and more volume, then you will achieve break-even position late. If you will make if you will invest the whatever your initial investment is, if you are getting that money back in less time, so your payback period is also affected in that. Quality of products, see, quality of products will not going to create any kind of impact, so it will result in break even point, payback period, investment decision if you are changing the cost, volume, profit of your company, but not in the quality of product. So 1, 2 and 4 is the correct answer. Next is, a project requires an initial investment of 2 lakh. The annual profit after tax is 40,000 and depreciation is 20,000. What is the payback period? So payback period is what? Payback period means how quickly the investor is recovering their initial amount. Yes, that is what the payback period is. So payback period formula is, that is original investment upon the annual cash inflows. Annual cash inflows. Yes, this is the formula of payback period. Now, a project requires initial investment of 2 lakh. So initial investment means original investment 2 lakh. Yes. Annual profit after tax. Okay. Okay. If you know, we have done one thing yesterday also, and in the paid class also we have done that capital budgeting has total two methods. One is the traditional methods and one is the modern methods. In traditional methods, we have payback period and we have accounting rate of return. In modern methods, we have NPV, we have MIRR, we have profitability index, we have IRR, we have discounted payback method. All right, payback period, MIRR, NPV, all these methods, they include which kind of cash flow? They include the CFAT. They follow CFAT cash flows. Rest only one method is ARR, that takes into consideration profit after tax. In the question, it says annual profit after tax. It is given PAT in the question. Okay, if PAT is given in the question, how to calculate CFAT? Because payback period includes CFAT. So simply you will add depreciation over there. So what you will do? From 40,000, simply you will add 20,000, you will get what? PAT. So you will get CFAT. So what is CFAT? That is 60,000. Formula was original investment, that is 2 lakh upon 60,000. So 2 lakh divided by 60,000 is what? That is 3.33 years. Means payback period is 3.33. Now, if you want to find actual how many months you need more to recover your initial amount, so 3 years are fixed. 0.33 into 12. If you will do 0.33 into 12, 0.33 into 12, then you will get 3.9. 3.96 means 4. So 3 years and 4 months. In 3 years and 4 months, you will recover your initial amount, that is 2 lakh rupees. All right, done. So 3.33 years. Now, next question. Calculate the margin of safety. Okay, how margin of safety is calculated? Margin of safety, that is sales minus break-even point in value divided by sales into 100. Yes, this is the formula. Okay, break-even point, how to calculate in sales? In sales means what? In rupees, how to calculate? The fixed cost upon PV ratio. PV ratio is, okay, PV ratio is not given in the question. Next step is to calculate the PV ratio, that is contribution upon sales into 100. Contribution, how to calculate contribution? Sales minus variable cost. Sales are how much? 60 lakh. Minus variable cost is 55% of sales. So 60 lakh minus 55%. That is what? That is 27 lakh. So contribution is what? Contribution is 27 lakh. Upon sales is 60 lakh into 100. So 27 upon 60 into 100, that is 45%. So PV ratio is what? 45%. Clear? Okay, so break-even point in sales. Now, next step is to calculate break-even point in sales. When we have calculated the PV ratio, break-even point in sales, that is fixed ratio, fixed cost is 18 lakh upon 45%. So 18 lakh upon 45% is what? That is 40 lakh. So 40 lakh is what? That is the break-even point sales. Now, next part of the last part of the question, how to calculate sales are how much? Sales are 60 lakh minus break-even point sales are given how much? 40 lakh upon 60 lakh into 100. So 20 lakh upon 60 lakh into 100. 20 divided by 60. So it is how much? 33.33%. So 33.33%. That is option B. Clear? 33.33%. That is what margin of safety is. Next question is, that is 48. Okay, machining is given to you, quality control, procurement is given, machine hours given, inspection, purchase order is given, 10,000 hours, 600, 400. Product Z consumes 2,500 machine hours, 180 inspection and 100 purchase order. What is the total overhead cost allocated to product X under ABC? So activity cost driver rate is given, that is machine hours, inspection, purchase order. Okay, so all the total cost value is given. Machine, what are the machine hours? Machining, the total value is 5 lakh, 3 lakh. Procurement is 2 lakh. So first calculate the activity cost to driver rate. So machine is given how much? That is 5 lakh. Okay, upon 10,000. Then quality control is how much? 3 lakh upon 600. Then procurement is how much? 2 lakh upon 400. So it is 10,000. No? So 5 lakh divided by 10,000, it is 50. This is what? This will come 50. 3 lakh divided by 600, it will come how much? 500. 2 lakh divided by 400, it will come also 500. Now, next is what is the total overhead cost? So, we have calculated the rates also. So, product X consumes how much? 2,500 machine hours, 2,500 machine hour. And what is the cost of one machine hour? That is the 50. Then second is the 180 inspection, in 180 inspection and 100 purchase order. So 180 inspection, what is the quality control? We have calculated 500. So 180 into 500. And next is what? That is 500. And purchase order is how much? 100 purchase order. So 100 into 500. So that is 250 into 2,500 into 50, that is 125,000. 180 180 into 500, 90,000. And this is, now calculate total value. That is 2,65,000. So total overhead cost allocated to product Z under ABC costing is how much? That is 2,65,000. Okay, so answer is 2,65,000. Understood? Next, question number 49. Omega Machines Limited is evaluating two projects, P and Q. Project P has a profitability index of 1.25x. Project Q has profitability index of 0.9. The company has a capital constraint and company can only choose one project. See, what is the decision criteria of profitability index? What it calculates? It calculates the relation between the cost and benefit of the project. Formula of profitability index, present value of cash inflow upon present value of cash outflow. What is the decision criteria of profitability index? So if PI is greater than 1, accept the project. If PI is equal to 1, indifferent. And if PI is less than 1, reject the project. So already it is less than 1, 0.9. So this project will be rejected. Which will be accepted? Profitability index of 1.25. That is project P. So project Q, no, it will be rejected. Project Q, it will be rejected. Neither, no. One project will be selected. That is project P. Because profitability index is greater than 1 means project is generating more value than it costs. So these are all the decision criteria of profitability index. Okay, one question we have done of payback period. What is the decision criteria of payback period? That is lower the better. So lower payback, we will select that project. Next, question number 50. Column A, column B, high operating leverage, high financial leverage, DFL greater than 1 or combined leverage means OL into FL. High operating leverage means what? That is how much sensitive the EBIT is with respect to sales change. If you are changing your sales, if you are little bit, if you are changing your sales, your EBIT will change a lot. And we have seen one example also in yesterday's session. That is the shoe example, if you remember. So operating leverage, high sensitivity of EBIT to sales change. So that is why it says percentage change in EBIT upon percentage change in sales. That is of OL. Similarly, degree of financial leverage talks about the percentage change in EPS upon percentage change in EBIT. DFL is greater than 1 means the firm is making the profit, it is above than the break-even point. DFL means when the financial leverage is greater than 1. It means you have taken more funds, you have taken more loan. If you have taken more loan, you will do more business, you will do more operation. If you will do more operations in your business, you will make more profit. If you will make more profit, you will achieve above the break-even point. The firm will be above the break-even point, and with this, the EBIT and the earning per share will move in the same direction. Combined leverage is what? OL into FL. So it includes the features of both fixed financial leverage into operating leverage. Q QPRS. QPRS. Option A. Next, question number 51, assertion and reasoning. So in cost volume profit analysis, a lower break-even point is preferred over a higher break-even point when comparing two business alternatives. Yes, we know that lower break-even point is what it is healthy for the company. As soon the company achieves its break-even position, it means after that whatever company will make the profit to company will make profit. And if the company takes more time to achieve the break-even position, it means company is not a healthy company. So in CVP, a lower break-even point is preferred over high, correct? A lower BEP means business needs to generate less revenue before it start making profit. Means the business has made less revenue to cover its costs, and after that, whatever revenue the company will make, it will give the profit to the company, and with that, the financial risk is very less. So both the statements are correct, and R is the correct explanation of A. How correct explanation? Read again the statements. In CVP analysis, a lower break-even point is preferred over a high break-even point. Why? Because low break-even point means the business needs to generate less revenue in order to achieve its break-even situation, and which reduces financial risk. Like if you have made the revenue of 50,000, one company is achieving at break-even situation by making the revenue of 50,000. Another company is making the revenue of 20,000, and with that 20,000 the firm has achieved the break even position. So which company is in a better position? Definitely company B. Why? Because company B has earned less revenue and achieved the break even situation, whereas company B has earned 50,000, 30,000 more the company has to earn in order to achieve the break even position. That is why the lower break even position is considered to be healthy, and higher break-even point is not healthy for the company. Next, in the activity-based costing, the formula to calculate the rate of cost driver is what? That is, cost driver rate is cost of activity pool upon the activity driver rate. Option B. Next, question number 53. ABC Limited wants to expand its production capacity to meet growing market demand. However, company is lacking the necessary capital to invest in new machinery, factory and workforce expansion. Traditional funding methods such as internal reserves, these are not adequate. And the finance manager has given out of the following requirements for the funding, because company wants to expand its operation, expand its production capacity, but the company does not have enough capital to invest in new machinery, to buy new machines, to expand their workforce. And with that, the company has used its internal reserves, but that internal reserves were not sufficient for the company. So in that case, company takes what type of funding method? The loan is required for a period of 7 years and cash flows generated. Company is ready to give its tangible assets as collateral, and the loan should not be convertible into equity. So what does it indicates? It's the part of term loan. Option A. Next, question number 54. Okay, see, I will upload the PDF. Just give me the reminder. Okay, remind me on the Telegram that I have not uploaded the PDF. If I will upload, it's okay. If I have not uploaded, just remind me. Okay, after the session gets over, I'll upload the PDF there. And moreover, one request from you all. I hope till now you all have subscribed the channel. You all have liked the video. If you are watching from 6 p.m. onwards, and if you feel session is helpful to you, like the session and share it also. Okay, so these are all the explanation part. Yes, next question. Question number 54. What it says, an external textile exporter expect to receive a payment of $50,000 in 4 months. And that exporter fears that the Indian rupee might appreciate against the dollar. So exporter has entered into the contract today. if you have the fear that the prices might increase in future, so you will enter the contract now, and you will have the option that you can exercise your contract. So what is this type of activity mean? So exporter is entering into the contract today to lock the exchange rate. Meanwhile, at the same time, the local trader buys dollars today, and the local trader feels that they believes that the price will going to rise in next week, and when the price will rise, then the local trader will buy all the dollars at that high price. So two different activities are there. One is talking about that the price may not increase in future, so I'm engaging in the contract right now. So this is the part of hedging, and this is the part of believing that the prices will increase in future, then you will sell. So it's a part of speculation. So in this case, the exporter is what? Exporter is the hedging, and trader is what? That is speculation. So option C. Next, question number 55. What is the internal rate of return for a project having cash flows of 40,000 per year for 10 years at a cost of 2,26,009? The internal rate of return is what? Internal rate of return, it is a discounting rate. It is a discounting rate where NPV equals to zero. So we have to find that rate where all our NPV equals to zero. Now, NPV is what? That is the net present value. Net present value, see, it says having cash flows of 40,000 per year, and at in original cost was how much? That is 2,26,000. NPV is equal to zero means what? What is the formula of NPV? Present value of cash inflow minus present value of cash outflow. When NPV will become zero? When you have got 100 rupees, and you have incurred 100 rupees. You have received 100 rupees, and you have invested 100 rupees. It means that is zero. So what it means that I have to bring my answer at this value, then only the NPV will equal to zero. And where NPV will equal to zero, at what point, at what percentage the NPV will equal to zero, that is what? Internal rate of return. So normally if such question comes in exam, okay, solve with this question with the help of hit and trial method. Hit and trial method means with the options. Go with the options. If you will solve, see, you have to calculate the present value of all the years in the internal rate of return. Then you will check with each value till 10 years that whether the NPV is coming zero, whether NPV is coming zero in with the help of formula. So hit and trial method will, in this method, what you have to make your entire cash flows, you have to bring your entire cash flows equal to this amount. So at what rate your cash flows will come equal to this amount, that point is IRR. So we will do with the method of hit and trial method. Now hit and trial method, see, answer is option D. So I'll explain you with this question only. How 12%? Okay, how 12% is what? 12% is the discounting rate. How to convert this 12% into years? So 1 plus 1, 1 upon 1 plus R upon N. What is 12%? 1 upon 1 plus 12%. So it is what? It is 1 upon 1.12. Simply what wait, let me turn off the camera. Simply what you will do equal to in this case. Yes. So 1 upon 1.12 is what? For first year. So 1 upon 1.12, you will do 1 divided by 1.12. You will do equal to, because in every year you are getting the same cash flow. So with the help of this method, you can calculate equal to, then you will type M plus for first year. 1 divided by 1.12 equal to M plus for first year. So it is how much? It is 0.89. Then you will do equal to M plus for second year. So till 10 year we have to do. That is coming how much? 0.797. then equal to M plus for third year also, equal to M plus for third year, so it is 0.711, then equal to M plus for fourth year, so equal to M plus, so 0.635. Okay, so I'm calculating and writing 0.635 equal to equal to M plus, then again equal to M plus till 10th year. So it is coming total value. Okay, after when the value comes, then you have to type after the 10th year. If you have typed, then you have to type the MRC memory recalled button. Okay, if you will type MRC, you are getting how much? 5.65. Now this 5.65, this is the discounting factor of all the 10 years. Simply multiply it by the 40,000. So 5.65 into 40,000, that is what you are getting, 22600. So 22600, okay, it is 226,00900. So it's somewhat same. So it means what is the IRR? The 12% IRR. IRR, internal rate of return, is what? 12%, where the NPV equals to 0. All right, done. How to solve such questions? And what is the decision criteria of IRR? So if IRR is greater than cost of capital, accept that project. If IRR is less than cost of capital, reject the project. I hope this is clear to you. Now, next question. So what it says, calculate the expected return with the help of CAPM model. So what is the formula of CAPM model? Risk-free rate plus beta into RM minus RF. Risk-free rate is what? 6% plus beta is 1.2. Okay, expected market return is 13% minus risk-free rate is 6%. So 6% plus 1.2 into 7. 6% plus 1.2 into 7 is 1.2 into 7. That is 8.4. So 8.4 plus 6. So it is 14.4%. So 14.4% option is clear. Okay, next 57. Statement 1, 2, 3. Unlike CAPM, which relies only on market risk, arbitrage pricing theory suggests that returns depends on multiple macroeconomic factors. Yes, CAPM model says that the risk is based on the systemic risk. Okay, systemic risk, the market risk. But arbitrage pricing theory says that the return depends upon risk, depends upon all the factors, not only one specific factor, that is systemic risk. Correct. APT theory developed by Stephen Ross, and it is the idea of taking the advantage of price differences. Yes, APT is what? Arbitrage. Arbitrage is what? It is the process the investors make profit from the price differences. Like they will buy shares or securities from one market where the price is very low, or any of the thing, and they will sell that particular share securities in another market where the price is comparatively high. So with the low and high price, whatever the differences is, that is the profit of the arbitrator. So arbitrator will going to make profit with the help of price differentials. Yes, this is correct. If an asset is mispriced according to ABT, arbitrators will trade it until price adjusts back to fair value. No. In APT, see, in APT, the arbitrators, they are only concerned with the profit made by the price differences. They will not going to wait until the price will adjust back. Then if the price will adjust back, then what is the need of purchasing the low securities and then waiting for the prices to become high? So this they will not going to wait. They will make the profit when the prices are very high. 1 and 2 are correct. Okay, so arbitrage pricing theory says the return you expect from an investment, it depends upon many things. Okay, like many things, the GDP, the inflation, the deflation, the oil prices, the commodity prices. So it depends upon many things. Inflation, interest rate changes in oil prices. Whereas CAPM model says that it says return depends only on the market. Market means the systemic risk. This is very important. Systemic risk means the risk that can affect the entire market. Clear? Next, a stock return is influenced by two factors. One is the inflation, one is the industrial production. Calculate the expected return using the APT formula. So what is the APT formula? Formula of APT is risk-free rate plus beta 1 into risk premium 1 plus beta 2 into risk premium 2. Only two factors are given, so 2. Risk-free rate is what? It is 5%. Plus beta 1 is 1.2 into risk premium 4% plus beta 2 is what? Uh, okay, beta 1 was 0.5. Wait, beta 1 was 0.5. So 5% plus beta 1 was 0.5 into 3%. Can we write 0.03? Yes, plus beta 2 1.2 and risk premium 2 that is 4%. So into 0.04. Now 5% plus calculate this 0.5 into 0.03, okay, plus 1.2 into 0.04 equal to into 100. So it is what? 4, 6, wait, 0.5 into 0.03. So it is 0.015 plus 1, 1.2 into 0.04. 0.048 plus 0.015. So this is what? This is 0.063 into 100. 6.3. So 5 plus 6.3 is how much? That is 11.3%. So option B. Clear? 11.3%. Now next, a finance manager is focusing on day-to-day liquidity management rather than investment or financing strategy. Which decision is most relevant in this context? So day-to-day liquidity management means the manager is focusing on their working capital management, okay, requirement of working capital. So choosing issuing bonds or equity, again, these are the long term, these are not for the short term. Day-to-day liquidity management, that is working capital, is for what? For the short term. So short term decisions are taken. Dividend payout policy, again, it is long term. Regulating cash, receivables, inventory, these are what? These are the short term. And 10-year expansion, already 10-year is stated, it means it is the long term. So option C. What is the primary difference between discounting and compounding? Discounting means converting the future value into the present value, and compounding means converting the present value to the future value. So discounting calculates the present value of all the future cash inflows, while compounding calculates the future value of all the present cash flow. Means the money that you are receiving in future, what is its present value? That is what the discounting calculates. And right now you are receiving 10,000 rupees. What is its value in future term? That is what? That is compounding. So in discounting, we come from future to present, and in compounding, we go from present to future. Okay, so compounding, we go from present to future, and in discounting, we go from future to present to find the present value of all the future cash inflows. So these are all the you can say example is given how we go from present to future and future to present. So I will upload the PDF. So kindly download and go through all these slides. Next, question number 61. So statement 1, statement 2, statement 3. So under the home currency approach, foreign cash flows are converted into the home currency. Yes, in home currency approach, we convert the foreign cash flows into the home currency. Then we see what are the exchange rate that is prevailing before doing the discounting. Correct. The foreign currency approach requires the cash flows to remain in the foreign currency through the entire evaluation process without ever being converted. See, in foreign currency approach, first you have see first the Indian market. According to the Indian market, you will do the discounting. You will see the value. You will check the interest rate, currency rate. Then you will convert it in your foreign currency. Then you will see, you will check what how much you have earned. You will apply the discounting rate. But it says without ever being converted. No, we have to convert it into the first. We have to convert it into the home country. Then home currency will be converted into future currency approach. So both the home currency and foreign currency approaches should yield the same net present value if exchange rate and interest rate are consistent. Yes, if exchange rate or interest rate are same in both the country, then the same NPV will come. So 1 and 3 are correct. Option B. Just a minute. All right. Now, next question number 62. Okay, it is done 62. Assertion and reasoning. So what assertion says in practice, a company may require high risk premium for a project in US compared to similar project in India. Yes. If the company is requiring high risk premium for the project in US as compared to similar project, see in India or in US, we have the currency differentiation is there. The value of the dollar is always appreciated as compared to the Indian currency. So company require the higher risk also when they are doing the foreign investments, foreign transactions. Overseas project involve additional risk such as trade barriers, currency fluctuation. Yes. What is the risk in this? What higher risk the Indian project has to face? That is, they have the overseas project, they have the additional risk. If the Indian is investing in any foreign country project, then the additional risk will be there. Trade barriers, currency fluctuation, and stringent, strict international laws are also there. So both the statements are true. Now relate whether the reasoning is correctly defining assertion or not. So in practice, company require higher risk premium for a project in US because if high risk is there, then high premium will be given by the US company. Why? Because it involves many different types of risk like trade barriers, currency fluctuation, and more. So both A and R are true, and R is the correct explanation of A. Now, reinvestment assumption in the case of IRR technique assumes what? That cash flows are reinvested in the project IRR. Cash flows can be reinvested at the WACC, reinvested marginal cost, and none of the above. See, what is one of the demerit of IRR is what? In IRR, what it assumes that whatever profit, whatever returns the company has made by following IRR method, the same money will be reinvested at the IRR project only. But it is not feasible, it is not possible that the money which you have earned from the project you will going to reinvest the same money in the same project only. Suppose from project A you have earned 10,000 rupees. Now this 10,000 rupees, either you will going to reinvest in the same IRR in the same project again. No, you will see another project, you will search another project, and there you will going to reinvest. Not every time you will going to reinvest in the same project, but IRR says that The cash flows it are reinvested at the project IRR. This is the assumption that IRR makes, and to avoid this assumption, that is why the MIR came into the picture. So MIRR says that the cash flows are reinvested at the realistic rate, not at the IRR project. Option A. Next, question number 64. Soumya Creation is expected to pay an annual dividend of rupees 0.80 a share next year. Okay, next year is paid. So it means D1 is given 0.80. Market price is given how much? 22.40. And growth rate is what? Growth rate is 5%. So what is the firm's cost of equity? Cost of equity means we have to calculate KE. So D1 upon PO plus G. So D1 is how much? That is 0.8 upon 0.05. So what is the answer? 0.80 divided by 0.80, 0.80 divided by 22.40 plus 0.05. 22.40 plus 0.05 into 100. So it is 8.571428. So 8 point, we can take 8.57%. Option D. Next, question number 65. So Rohan Limited has 10 rupees 10 equity shares amounting to rupees 15 crore. Current market price per equity share is 60. Default risk-free interest rate is what? That is 5.5. Average market risk premium is 8%. So beta of the company is given 1.1875. Now we have to calculate the expected return. So how to calculate this? See, 10 rupees 10 equity shares amounting to rupees 15 crore. We don't have to do anything with this because the current price of the equity share is already given what? That is the 60. Okay, so how to calculate the expected return, that cost of equity? Wait, let me write it over here. Risk-free rate, again beta upon R minus RF. RF is what? RF is given, risk-free rate is given, that is 5.5. Plus beta is what? 1.1875 into RM minus RF. So already market risk premium is given, MRP is given. Market risk premium means RM minus RF. It itself means RM minus RF. So it is what? It is 8%. So 5.5 plus 1.1875, that is 9.5. 9, 10, 11, 12, 13, 14. So it is 15%. Option A. Clear? Next. A project NPV under different scenarios are there. So optimistic is known as the best scenario. The NPV is very high. Most likely means the base rate, that is in normal scenario, the NPV is normal, that is 80,000. And pessimistic means that is bad scenario. Bad means the worst scenario, the 40,000. Calculate the NPV and see, in this only the probabilities are given, means the chance is there that if the situation will be best, then this much amount the company will make. So what is the probability? 0.2% is the probability, 0.5 is the probability for most likely, and 0.3 is the probability of pessimistic. So how to calculate? 1,20,000 into what is the probability? 0.2. 80,000, what is the probability? 0.5. And 40,000, what is the probability? 0.3. So 12, 1,20,000 into 0.2. So it is 24,000. Similarly, 8 fives are 40,000. And this is 4 threes are 12,000. So 4, 5, 6, 1, 7, 6, 4, 5, 6, 7, 76,000. So expected NPV by following the probabilities is 76,000. Option A. Next, PV ratio is 40%, fixed cost is 60, find break even point in sales. Sales means, see, break even point can be calculated in two ways. One is in units, one is in rupees. Rupees means break even sales. Unit, what is the formula? Fixed cost upon contribution per unit. And sales, what is the formula? Fixed cost upon PV ratio. Already the PV ratio is given 40%. If not given, then how to calculate contribution by sales into 100. So already given PV ratio 60,000 divided by 40%. So it would be 60,000 divided by 40%. So it is 150,000. So 1,50,000, option C. Okay, 1,50,000. Now next, question number 68. So hedging, speculation, arbitrage. What is the difference between these terms? Hedging is what? Hedging is basically done to protect from the losses, limiting your loss to a certain limit, limiting a loss to a certain limit. So hedging to protect against the potential losses from price fails in future. Speculation means that is gambling, doing gambling for profit, that the in future the profit will in future the price will be high, then we will exercise the instrument. And arbitrage means from price differentials, the risk-free profit is made by the arbitrators. So here zero investment is there, again risk-free profit is there, and the returns are always positive. So 3, 1. So 1 is 2, 2, 3, 1. 2, 3, 1. Option B. Next, question number 69. Which of the following is the correct sequence of steps in ABC costing? Option A, identification of main. C. First, you will identify the main objectives. Okay, then after that, you will do the other part of the thing. So, collection of cost of pool is eliminated. Determination of activity cost driver is eliminated. First, we'll identify the main activities. Once the main activities are identified, then we will collect the cost of all the different activities. That is collecting the cost pool. After collecting the cost pool, then we will decide the activity driver rate, determine the activity driver rate to each one of them. What is the activity driver rate of purchase order machines? After that, the calculation of activity cost to driver rate. And last is then we will give the cost, we will assign the cost to each of the respective activities. So identification of main activities, collection of cost pool, determination of activity cost to driver, calculation of activity driver rate, and then charging the cost of activities to products. Option A. And this is very, very important. All right, so these are all the points. Next, 70. Fixed cost, variable cost, cost pool, cost driver. So fixed cost is the cost that do not change with output. Variable cost that changes with the output. Cost pool means collection of all the cost of all the activities. And cost driver means the thing that causes cost to happen. So it is the factor that causes cost to happen. So it is related parallelly. So 1, 2, 3, and 4. Next, question number 71. Dash is a mechanism that involves setting prices for transaction between related entities within a multinational corporation to ensure the fairness and compliance with international tax regulation. What should be the answer? See, what is basically what the question is asking? Question says that the how what are the different tactics the company will use, how the company will going to charge, okay, when one branch or subsidiary of a company is selling goods or services to another. So this is mainly used in the transfer pricing. In transfer pricing, what we do in transfer pricing, the price is charged when one company, when one branch, or when subsidiary of a company sells goods to or services to another subsidiary or another branches of the same company. Like for example, um, suppose ABC Limited has one subsidiary in India also, and ABC Limited is having one subsidiary in USA also. The Indian subsidiary manufactures a product for rupees 1000, and it directly sells to the USA subsidiary. Now the price that is charged between these two related companies is called the transfer price. Suppose India subsidiary sells to USA subsidiary at rupees 12,000. Okay, and 12,000 or 1,200 is what? That is the transfer price. So at what amount the Indian company is selling their goods to the subsidiary company that is situated in other countries, so that is known as the transfer pricing. The price charged between these two related companies. So different companies, why this is used in the case of international transaction? Because different companies, they have different tax rate, and a company may try to set their own prices, their own rates to shift the profit to another companies. That is why this transfer pricing is used, so that the company may not show the lower taxes, may not give lower taxes to the government. So tax authorities require that transfer prices should be used in a fair manner and similar to market price. And transfer price, the another okay, what is the another name of the transfer price? Can anyone tell me? What is the another name of the transfer price? That is arm length price. That is the another name of transfer price. All right. So let's take a break for 10 minutes, and then we'll proceed with our module C and module D MCQs. All right. And so far, if you have not yet subscribed the channel, do it now. So let's take a break for 10 minutes. All right, I hope I'm audible properly. Okay, so let's start. So we have completed two modules, module A and B. Let's start with our module C of 30 more questions. So next question number 72. So same, okay, not the same data. The XYZ Limited, okay, EBIT is given 6 lakh, tax rate is given 25%. What is the net operating profit less adjusted tax? So no plat is net operating profit less adjusted taxes. So what is the formula of no plat net operating profit less adjusted tax? That is EBIT, okay, earnings before interest and tax into 1 minus tax rate. So EBIT is 6 lakh into 1 minus tax rate means 1 minus 0.25. So 6 lakh into 0 into 0.75. What is the amount? So 6 lakh into 0.75. That is what? 4 lakh 50,000. So we have 4 lakh 50,000 in our second option, that is B. So question number 72, the answer is option B. Next, the direct comparison approach is founded on the principle of what? This several times we have done. The direct comparison approach is founded on the principle of substitution. Principle of substitution, which states that the buyer will not going to pay for a given property than the cost of which property? Than a cost of comparable property. So direct comparison approach is also known as the market based approach. Market based approach, that is option A. Next, question number 74. Three statements are there. Three statements are there. Statement 1, debt in financial services companies is treated as an operational input rather than a source of capital. See, in financial services companies, debt plays a very important role because the core business, the core operation is what? It is on the debt only, it is on the loan. So financial services, it companies, it not treat the debt as an operational input. It treats the it treats debt as an operational input rather than just a source of capital. So it's not a source of capital. It is their core work. It is their core job. So that is why it will be treated as operational capital. All right. So one is correct. Reinvestment is easy to measure in banks. No. Just now we have seen when we have started module C that measuring the reinvestment is not possible in the financial services company because see you don't know how much the exact amount you will going to reinvest in another business or in another investment because market is completely dynamic, so you don't know what will happen next. Things are changing very frequently. Reinvestment is not easy to measure in banks because it is primarily comprised of capital expenditure and fixed assets. It is not easy to measure, and the banks they have to make provisions for their losses that creates challenges, and it will help them to estimate the true income of the firms. So when the provisioning for losses, when the banks they are making provisions, it makes difficult for the banks that what their true income would be in future, because if the NPA rises very high, then they have to make high provisioning for that. Okay, so it creates challenges in estimating the true income of the companies. Yes, this is also correct. So 1 and 3 are correct. Okay, so 2 is wrong. Next, assertion and reasoning. Assertion, what it says, the price to book multiple is considered more stable metric than price to earning multiple for companies with unstable profit. Yes. See, price to book value is more stable. Why? Because all the values they are mentioned at their historical cost, and book value changes very slowly, very gradually. Why? Because only depreciation changes affect the book value. But in price to earning, because price to earning is what? That is market price per share upon the earnings per share. So as the market changes, the earnings of the company also changes very quickly. So it is considered more stable. Price to book value, correct. Price to earning, it is not stable. Yes, this is also correct. Book value represents why this is not stable or why book value is stable, because book value represents the accounting value of equity and it changes slowly, gradually based on the balance sheet. So only the what the value that you will reduce from your fixed asset, that value is only changing. Rest of the value is not changing. So assets and liabilities, they are changing very slowly. So this is also correct, and reasoning is also correctly defining assertion. So both the statements are correct and R is the correct explanation of A. Why? Book price to book multiple is considered more stable than price to earning. Why? Because price to book value, it includes all the historical cost. It changes gradually in the company, whereas price to earning, it changes quickly as according to the market standard. So book represents accounting value of equity and changes slowly. So option A. Next, question number 76. Total assets at market value minus total liabilities at market value. So this is what market value. Market value is considered in which adjusted book value or cost based method. So adjusted book value is the given answer. EBIT into 1 minus tax rate. Just now we have done in this question. See, no plat EBIT into 1 minus tax rate. So this is what, this is the formula of no plat, net or operating profit less adjusted taxes. Then net fixed asset plus working capital, that is OIC, operating invested capital, and capital expenditure increase in working capital depreciation is a part of net investment. So we have R, then P, then S and Q. So R, P, S, Q. Next, this is important question. The capital asset pricing model describes the relationship between what? Just now we have done. It describes the relationship between your return and your systemic risk. So systemic risk and expected return. Which of the following correctly represents the formula for no plat? Formula for no plat is what? That is EBIT minus taxes on EBIT. Okay, we can do in this way. We can take EBIT as common also into 1 minus tax rate. Yes, can I write in this way also? If I will take EBIT common, so EBIT, then EBIT into 1 minus tax rate. So what if you will make this formula, so EBIT into 1, that is EBIT minus taxes on EBIT. So both of the formula are same. We can write in any of the way. Next, 79. Assertion and reasoning. Economies of scale and economies of scope are essentially the same concept that can be used interchangeably in the context of merger. In the context of merger, economies of scale and economies of scope, these are the two same things? No, these are not the same things. Both economy of scale and scope lead to cost reduction, though the former arises from increased volume. Yes, in both the case, the cost will be reduced, but in economies of scale, as you increase your production, okay, the per value cost of product will decrease. And the economies of scope is what? That is when you are producing multiple items, then your cost of production will reduce. Cost of producing one product, it will reduce. So this is correct, but it is not correct because assertion says that both are the same concept. No, economies of scale and scope, these are not the same concept. So A is incorrect, R is correct. In scale, as and when you increase your production, the cost of producing one unit decreases. And economies of scale, in this, with one resource, with one with one item, how many different products you can make. That is what economies of scope. So scale is what? It refers to saving the cost due to increase in output produced, and economies of scope is what? In this, two or more distinct products are produced. So here the average cost of production reduces, and here average cost of producing multiple item reduces. So it is with volume, the cost advantage is due to volume and it is due to the variety. Like from, okay, milk. From milk you can make paneer also. From milk you can make sweets also. From milk you can make kheer also. Okay, from milk you can make ice cream also. So Product is one, but you can make n number of items with the same product. So this is what? This is the economy of scope. Next. So technology giant once held the capability to develop a dominant operating system for personal computer. And however, it chose to seed the specific business segment to a newcomer, Microsoft. So, which type of case study it is talking about? What was the strategic blunder that the company has done? So, which company has done the strategic blunder? The company has given its formula, given its idea, or sold its operating system to whom? To a newcomer, that is Microsoft, by the year 1989, and the entire market disrupted. So whose companies, whose which industry was entire market was disrupted? Kodak, Xerox, IBM, yeah, Fuji Films. So that is IBM, option C. Next, 81. John Maynard Keynes have identified three motivations for holding money. One is for transaction, one is for protection against planned expenses. So if any kind of natural calamities arises or any kind of circumstances that is not according to the company that has arisen. So for unplanned expenses, the money provides the motivation for transaction, and third is for the speculative purpose. Speculative purpose, it doesn't only means the gambling purpose. It means that if the company gets good opportunity also, if company gets opportunity to invest in big project, so that is also included here, not only the speculative gambling. So unplanned expenses and the speculative purposes. Next, question number 82. PEG ratio, PE ratio, EV upon FCFF, or the value ratio. You have to match the following all this. So what is the first? It says that is the PEG ratio. So PEG ratio is what? See, PEG ratio is price earning to growth ratio. It is again a valuation measure that compares a company's price to earning ratio with its expected how much the company will going to make a growth in its time period. So PE ratio tells us what? That how much the investors they are willing to pay for 1 rupee of the earnings in your company. And it doesn't matter that the earnings are made and the company is making the earnings fast or the company is making the earnings very slow. So it does not consider how fast those earnings are expected to grow in future. PEG ratio solves this problem by including the growth pattern also. It helps the investors to make a judgment that whether a stock price is reasonable according to its growth or not. Like for example, if two companies they have the same PE ratio of 20. All right, one is expected to grow their earnings at 20%, while another is expected to grow their earnings at 10%. So the one who is growing their earnings at 20%, that company is more attractive for the investors because investors they want in less time, they want more growth and more return. So the PEG ratio, it will tell you that how much time it will take to make the company in how less time the company is growing. So PEG ratio, that is all about the PE ratio upon the expected growth rate. So what is the expected growth rate of the company with respect to the PE ratio? Then PE ratio fundamental is what? This is the formula 1 minus B upon R minus return on equity into B. P is again it is what? It is the retention ratio, and 1 minus B is what? That is the DPR. What is the full form of DPR? That is the uh, dividend payout ratio. So dividend payout ratio means what money you are paying to your dividend, that is DPR, and what money you are keeping as retained earnings, that is denoted as what? That is denoted as B. All right. Now EV upon FCFF is what? That is enterprise upon free cash flow to firm. Free cash flow to firm means 1 upon back minus growth, weighted average cost of capital. And value ratio is either price, either book value or ROE. So this is related to, so we have 2, 1, 3, and 4. 2, 1, 3, and 4. Option A. Next, question number 83. Trademark, copyright, franchise, and patent. So trademark is what? It is the mainly our you can say a protection is provided if the company is using their company has made any kind of logo, words, names, symbols are there, so that it may describe that company separately. That is why the company they filed for the trademark. So protection for words, names, or symbols. Copyright is what? The exclusive right is given to control the copying of a creative work. Like for example, the Macmillan book. Can anyone copy the content of the Macmillan book and they can sell it in their own name? No, it is not allowed because the Macmillan then the copyright Macmillan will claim for the copyright. So copyrights are there. It will give you the exclusive right that no one can copy your content and they can sell it in their own name. Franchisee is what? Franchisee is again a legal title or legal usage is given to the company. The brand is given to a third party. Like franchisee is given example for like Pizza Hut or Domino's. So they have the franchisee, they have the formula. Okay, they know how they have to produce the products and what is the brand is given. So it grants a legal use to use the brand. So brand is the main element in the franchisee. So if you are selling the pizza in some other name, so nobody will purchase. But if you know the Domino's is there, the Pizza Hut is there, the Lapinos are there, so you know that brand is creating that value. So franchisee is granting legal use of a brand to a third party, giving the brand so that they can use your brand name, they can sell the product in your name to a third party. And patent is what? It is what? Unique valuation based on remaining life, utility, market price. So we have 2, 1, 3, and 4. 2, 1, 3, and 4. Option A. Now next, find the P multiple for V and S company based on these fundamental determinants. So P multiple, that is price to earning multiple. So return on equity is given, cost of equity is given, dividend payout is given, and retention ratio is given. All right. If only dividend payout was given in the question, can you find the retention ratio? If only dividend payout was given in the question, can you find the retention ratio? Tell me. Huh? Can you tell me if only dividend payout given, can you find the retention ratio? Yes, dividend payout is what? How much money you have paid to the company and how much you have retained in the company. You have 10 rupees, you have paid 4 rupees, how much you have retained? 6. If DPR was given only 0.3, so can we calculate the retention ratio? Yes, 1 minus 0.3. What is 0.7? If it is not given in the question, still we can calculate it. Or if this is not given in the question, only this is given, we can calculate. Yes. So what find the P multiple? So what is the formula? 1 minus P. Okay, then R minus R return on equity. Wait, just ROE minus R, na? Just a minute. All right, so 1 minus B. 1 minus B is already given in the question. That is return on equity. So ROE, okay, minus R into what? That is the B, this retention ratio R. So this is the formula. So 1 minus B is what? 1 minus B is 0.3. Then return on equity, that is, can I write 20% as 0.20? Yes, I can write 20% as 0.20. 0.20 minus 0.15, and what is the retention ratio? What is given B? That is 0.7. Now calculate this 0.20. Wait, my answer is coming different. Wait. Okay. Just a minute. Just a minute. So it would be R minus ROE into B. I have written it opposite. So 0.3 upon R is what? Small r, that is uh, cost of equity 0.15 minus 0.20 into 0.7. Yes, now the answer will come. So this is would be in bracket. So 0.20 minus 0.7 minus, so 0.3 upon 0.01. So 0.3 divided by 0.01. So it is 30. So yes, the answer comes how much? That is the 30 times. Option B. Alright. So formula is this one. R minus ROE into B. This is not. So option B is the correct answer. Yes, I have written it opposite. Alright. So R minus ROE into B. Now next, direct comparison approach is often used for which type of company? Manufacturing, MNC, conglomerate, or real estate business. So we have seen in special cases of valuation that these are the companies they need special type of requirement for doing the valuation of the company. So direct comparison is used for the real estate business. Option D. Next. XYZ Limited is expected to pay a dividend of rupees 5 per share 1 year from now. Again, 1 year from now, that is D1 is given 5. Dividends payment are expected to remain constant at 5 per share. Investor needs 12% rate of return. Yes, correct. I have written it correct over here. This is 1 minus B, R minus ROE into B. Clear? We have got the answer. That is 30. Okay, so what the question says that see, in this question, what says that the dividend grows 1 year from now, that is 5%, but that dividend is growing at a constant rate. Constant rate means at the same rate. Rate means the growth is what? The zero growth is there. If you anything is growing at the same rate, then no growth is there. So if the zero, what is the zero growth model? That is D1 upon P, that is the zero growth model. Yes, D1 upon P or D1 upon you can if you are finding the growth is constant, so you will take the constant growth. Constant growth, the same growth of the company. So what is the market price? You have to calculate the market price of the share. So market price of the share is D1 upon growth of the company. Here, no return on equity, no nothing we will use. Why? Because the growth pattern is the same. So what is the answer? The 5 divided by what is 0.12. So that is 41.67. So 41.67 the answer is. So see, if the dividend growth pattern is given, then only we will add the growth in the formula. If only constant growth is given, constant growth means that is the zero growth, means no growth is there. So we will not include the growth in the dividend discounted model in the dividend formula. So the formula would be D1 upon KE, that is cost of equity or cost of capital. All right, so D1 upon KE, that is 5 upon 0.12, 5 upon 0.12, so 41.67. So option A is the correct answer. Next, in the context of mergers and acquisition, which of the following statement about exchange ratio, swap ratio is accurate? Exchange ratio is always fixed and cannot be adjusted after the initial proposal. Exchange ratio greater than 1. See, exchange ratio, it is not always fixed because we know that the market is not static. Market fluctuates a lot. The market is very much dynamic. So exchange ratio will also fluctuate. And that is the reason now why the exchange interest rate risk or exchange rate risk arises when doing investment. Incorrect. Exchange ratio, if it is greater than 1, if exchange ratio is greater than 1, it implies that the acquiring company is offering more than one share of its stock for each share of the target company. If the exchange ratio is greater than 1, it means the acquiring company is offering how much? More than one share of its stock. So acquiring company is offering to the target company more than one share. Means if the value of the share is 10 rupees, then acquiring company is offering more than its value, like at the rate of 15 rupees, at the rate of 20 rupees for each share of the target company. Like one share of the target company is rupees 10. The acquiring company is offering rupees 15, rupees 20. Why this acquiring company is doing? Might be for the goodwill of the target company. The goodwill is high, the reputation is high in the market. That is why the exchange ratio is greater than the target company's one share. So exchange ratio greater than one implies acquiring company is offering more than one share of its stock to the target company. Next, a taxpayer in India may generally carry forward all the business losses for a period of how many assessment year in which the loss was first computed, succeeding the assessment year in which the loss was first computed. Succeeding the assessment year means suppose the loss was held in the year 2022. So after that 2023, 2024, 25, 26, 27, 28, 29. So 1, 2, 3, 4, 5, 6, 7, and 30. So by the year till 2030, the company has to set off all the accumulated losses. So till 8 year the time period is given. So now company can carry forward the losses of the amalgamating company up to a period of 8 assessment years. Clear? So that is option C. 8 assessment years. Next, compliance of which two laws are of the highest applicability to both the companies which are going to merge. So when two companies are merging, so what are the compliance related laws they have to follow? Which two laws are of the highest applicability? FEMA, Foreign Exchange Management Act, Income Tax Competition Act, Factories Act is not a part of this. If the companies are merging, then what the Factories Act will do? Pollution control, food adulteration. Again, see, if you don't know the answer, you can, from the elimination method, you can easily crack this. Now, what is left? Companies Act and CAIIB Act, payment, income tax. So when what companies are merging? Merging means they are coming together. Okay, the combination is there. So what two laws? If their combination is there, then again what is the new income structure of the company? Who would be the new shareholders? How the company will going to manage their foreign transactions? So all these things are most important. So that is FEMA and Income Tax Act. So option A. All right. So in the SEBI Act 1992, it is primarily concerned with the protecting of interest of the minority shareholders, the Competition Act, the Income Tax Act. These are the most important. They play the role. Now, question number 90. As on 31st March 2024, the XYZ Limited had 15 lakh shares that were still outstanding. The market value of XYZ Limited equity was 7.50 crore. Okay, so XYZ equity was how much? 7.50 crore. At the end of the trading on that day, it was priced at rupees 50 per share. So if you will multiply with 50 into 15 lakh into 50, then you will get 7.50 crore already mentioned over here. Additionally, at the end of 31st day of March 2024, the company had an outstanding debt that totaled how much? 15 crore. So after the end of the 31st March, the company is having the debt which was total around of 15 crore. But that 15 crore, its market valuation was 14.8 crore. Okay, according to this scenario, we have to calculate the total value as per the stock and debt approach. Now, in stock and debt approach or in adjusted book value method, we will take the fair market value. Yes, what is the market value of the assets? What is the market value of the liabilities? We take that. So in stock and debt approach, we will take the market value of equity plus market value of debt, outstanding debt. So what is the market value of equity? At that day, it was priced 15 rupees 50 per share, that is 7.50 crore. And total market valuation is how much? 14.80 crore. See, total debt was 15 crore, but we have to take the market value. So market value was how much? 14.80 crore. So plus 14.80. So how much it would be? 14.8 plus 7.5. So it is 22.30 crore. That is option A. Okay, all right. So these are all the explanation part given. Now, next, 91. One of the non-discounted cash flow valuation methods is enterprise valuation multiple model. Which are the following used in enterprise value multiple model? We have equity valuation multiple model, enterprise valuation multiple model. Now in enterprise valuation multiple model, what are the following different types of multiples are used? So we have EV upon EBITDA multiple, EV upon EBIT, EV upon N. All the formulas are very important. So do follow the formulas of this. Okay. Don't miss all the formulas. EV upon sales multiple. So all are included. So 1, 2, 3, 4, 5. Option D. Next, question number 92. All about calculate the weighted average cost of capital. The weights are given. Okay, debt is preference shares, equity share capitals, weight is given equity. What is the formula of WACC? So if it is given cost of debt that is 10% into the weight assigned for the debt, then cost of equity shares, cost of preference shares into what are the weight assigned to preference shares, plus cost of equity share plus the weight that is assigned to equity shares. So KD into WD, KP into WB, and KE into WE. So weight is how much? That is 35%, 10%. So 0.10 into 0.05, 0.35, 0.08 into 0.05, 0.16 into 0.60. So this way you can calculate, you will get 0.135. Now we will multiply, so 13.5 would be the answer. 0.35 into 0.10, 0.05 into 0.08. If you convert it into percentage, you will get these values. And again, if you will multiply it by 100, then because we have to get the answer in percentage, so that is 13.5%. All right, option A. Clear? Next, question number 93. XYZ Limited received approval from NCLT when on 1st July 2025 to hold a meeting of shareholders and creditors. So NCLT has received the XYZ has received the approval from NCLT on 1st July 2025 to hold a meeting of shareholders and creditors. The meeting is scheduled to be held on 5th August 2025. As per the Companies Act and NCLT procedure, by which latest date should XYZ Limited will send the notice to shareholders and creditors all about the mergers and acquisition process when the company is taking over another company. So company has to make certain provisions are to be followed by the SEBI, and in that the provisions was that the conditions are there that has to be followed. So when the company is making any kind of public announcement or company wants to send the notice to the shareholders and creditors, so it should be sent within 1 month. So it is see approval is given from on 1st July 2025, and the meeting is scheduled to be held on the 5th August 2025. It means at least within 1 month, before 1 month you have to provide the means 1 month time is given for the meeting and when you are sending the information. That is on 5th August the meeting is. So on 5th August 2025 you have to provide the information. Clear? So for meeting of shareholders and creditors ordered by at least 1 month before the date of the meeting. So when the date of the meeting is 10th August, then by 10th of July the intimation should be provided. So notice must be sent at least 1 month before 5th August. That is 5th July 2025. Next, 94. In India, the merger of a domestic company with a foreign company requires prior approval from which of the following authorities? So it requires a prior approval from Reserve Bank of India. Option A. A ratio that illustrates the stock market's readiness to pay for 1 rupee of earnings per share is referred to as earnings multiple. This is known as what? That investors they are willing to pay for 1 rupee of the revenue that is generated in the company. How much the investors are willing to pay in that 1 rupee of earning. That is known as the PE ratio, PE earnings. So ratio of price to earnings. So price to earning means the market price per share upon the earning per share. Next, 96. Corporate valuation is the process of determining the value of a company entity, and it is most commonly used in the context of financial industry. Again, two types of value is there. In the starting only we have seen what is the book value and the next is market value. Question number 97. Arrange the following steps in correct order of amalgamation or takeover. So application to NCLT is given first. Board will approve a draft policy. Filing of NCLT with the registrar of company. Then sending notice to shareholders, creditors. Petition filing to NCLT for final sanction or conducting shareholders or creditors meeting. What should be the first step? Can you eliminate the steps? See, 2 1 2 1 is given. It means either 2 would be the first step or 1 would be the first step. So first the board will approve the draft. Board will approve the draft policy that okay, the companies are amalgamating to form a new entity. So in that, after the board approval is given, then the application is submitted to the NCLT. So 2 it would be the first. So this one is eliminated and this one is eliminated. Now after two, the first is application is submitted to the NCLT. Now after submitting the application, filing is done with of NCLT order with ROC or sending notice to shareholders. So when application is given to NCLT, NCLT approves the application, then the notice will be provided to the shareholders and creditors. That notice will be provided for shareholders and creditors. After giving the notice, then the meeting will be conducted. Shareholders and the creditors, okay, they will try to talk. They will try to communicate. Okay, the matter on the amalgamation. Who would be the new shareholder if the company will be amalgamated? All these things. So next is what? Next is shareholders meeting will be conducted. Then after that, the petition to NCLT is filed for final sanction, and after that, the filing of NCLT order with registrar of company. So this would be the last step. Okay, so after the sanction is done for final sanction, then the filing will be done. So NCLT will be filed the order with ROC and the company will be amalgamated. A new company will be created like A plus B equals to C. So option A is the correct answer. Next, question number 98. Replacement cost of ABC's plant is 50,000 crore. Value of ABC's 50% shareholding in MNP Limited. This is another company, 60,000 crore. What is the shareholding? For 50% of the shareholding is in MNC Limited, that is 60,000. Cash holding are 9,000 crore and outstanding debt is 9,000 crore. So using the adjusted book value approach, find the net asset value. So what is the net asset value? That is the replacement cost of the company plus the value of the company. If the value of the company, if the company has taken the shareholding from different company, so how much shareholding is 50%? That all the cash will be included minus whatever outstanding debt are that will be deducted. So 50,000 plus 60,000 plus 9,000, it is 119,000 minus 9,000. So it is 110,000. 1,10,000 crore. 1,10,000 crore. So option D. All right. So this is 1,10,000. Next, question number 99. As per the H model of dividend discount model, identify the correct statements. So H model is what? It is another growth model that consists of two stage. Yes, H model. It includes two stage. In three stage model is the combination of two stage plus H model. And in three stage model, three stages are there. H model, it is developed by Fuller and Sia. This model assumes that earnings growth rate will remain stable forever after the stability has been achieved. Yes, when the company will grow, company is growing at a tremendous rate, like okay, company is growing at a tremendous rate like 2%, okay, then 6%, then 8%, then 10%, then 15%. After that, the company will decline gradually. Gradually means the linearly. Like 15, it is declining, okay, 2%. So, okay, let's take it 1%. So 14, then 13, then 12, then 11, and then it remains stable at 10%. Now this stability the company follows forever. So the moving at high speed, that is initial speed is GA. This is denoted as GA, and the company achieves a stable position that is denoted as GN. So it remains earnings growth rate will remain stable forever after the stability has been achieved. Yes, this is correct, this is correct, this is correct. This model also assumes the exceptional growth rate. Yes, exceptional growth rate is in the beginning stage, does not remain constant, but rather it okay increase linearly over time. So it not increase linearly, it decrease linearly. So this statement is wrong. 1, 2, and 3 are correct. Option B. Okay, so this is what? This is the H model. All right. So GA, this is GA and this is GN. So GA is sometimes denoted as G1 also and it is denoted as G2 also. Now question number 100. Horizontal merger, vertical, co-generic and reverse merger. So horizontal merger when companies they are related, they are merging in the same type of business. Vertical merger when there is the seller and buyer relation is there in different stages of production. Co-generic merger is what in this the company is connected. Okay, when company wants to expand their business operations in different industrial markets or market segments. And reverse merger when a when a smaller unlisted company is taking over the listed company, big listed company. So the two business that have recently merged operating in the same market, that is horizontal, buyer seller relationship vertical, acquiring company, companies merging connected in some way, fundamental technologies, industrial market segments, providing the complementary products, that is co-generic merger, and this is reverse merger. So 1, 2, 3, 4. 1, 2, 3, 4. Option A. Next, 101. For applying DCF method of valuing a firm or any other asset, which of the following inputs are required? See, applying the DCF means discounted cash flow valuation method. We have seen now four types of different inputs are required. One is the what is the nature of the cash flows, how much cash flow the company will going to generate in future. If the cash flows are generated in future, then risk is there, uncertainties is there. You have to find the present value of the future cash flows. So one should know the discounting rate, the present value interest factor. So it is calculated with the level of risk. The more risk, the more discounting factor. Estimated cash flow growth rate. What is the growth rate of the company? At what rate the company is growing? And what is the pattern of growth? Like zigzag pattern is there, then stable pattern is there, then high pattern is there, then suddenly low, then stable, then high, then low. So what is the pattern of? So all the things are related in this. Now next, that is module D. Question number 102. Bootstrapping generally happens in the idea phase. Yes. when the startup company, they have only developed the idea, the product is not yet made, the product is not yet executed, it is not in the actionable form, then in that case, who will provide the funds? The company will arrange the funds through bootstrapping. Bootstrapping is what? That is the savings of the savings of the person. Because in the idea phase, no venture capitalist, no private equity, no angel investors, they will not going to give you the money until and unless if you have made any product. Crowdfunding is common in seed stage. Yes, in seed stage, the individuals or the startup owners, they can collect the funds through crowd. Series A is used for expanding user base and geographics. So Series A, Series B stage funding is provided for reaching out the product in the different geographical areas. Scaling stage uses the VC funds, correct? And exit option include either the acquisition of the company, selling the company to another company, secondary buyout, or selling their stakes to another private investor. So any could be the exit option. Anyone could be the exit option. So all the five statements are correct. Now, what is the main objective of Startup India Yatra program? So Startup India Yatra program is what? In this, the the you can say the startup companies, they find the entrepreneurial talent from different states, and in which state? In tier 2, tier 3 state. So they travel in these states and they find the one who is having who is the entrepreneur and who is having much more talent to work in the startup companies. So to identify prospective business owners living in metropolitan areas, no, it is not in metropolitan, it is in tier 2, tier 3, so it comes under non-metropolitan area. So to identify prospective business owners living in non-metropolitan area, providing them with a venue, yes. Option B. They can pursue their dreams, they can fulfill their achievements, they can fulfill their targets and all. Next, 104. For SISFS, a startup must be DPIIT recognized. See, SIS is what? Startup India Seed Fund Scheme. So SISFS is what? This is Startup India Seed Fund Scheme. So if any startup company, they want to apply for the funding from SISFS, then they have to submit the application. And before submitting the application, the certain conditions are there that must need to be fulfilled when submitting the application for funding under Startup India Seed Fund Scheme. So what is for SISFS? A startup must be a DPIIT recognized startup. Yes, it must be recognized by DPIIT. The startup should not be more than 2 years old company. Correct. The startup should have the good use of technology. Correct. The startup should have already received more than 10 crore financial assistance from any government scheme that are eligible. See, startups, they should have received more than 10 crore financial assistance. In this, the prize money, the any other money, it is not included when the financial assistance the startups are taking from the government or okay, everything is okay now. Slide is visible, but yes, but I'm not able to see my slide. What happened? Am I audible? Slide is Just give me 1 minute. Now it's not visible, no? Okay. All right. Okay, now everything is okay. I'm also seeing my slide. Yes, so this is correct. Mm, yes, so startup should have the good technology when making any products. Okay, third one is startup that have already received more than 10 crore financial assistance from any government scheme are eligible. See, in that prize money and all the extra things, the workspace, office space, these are not included, and the startup should not have received more than 10 crore. So this is not a part of the condition. So it should have received less than 10 crore, not more than 10 crore. Means not more than 10 crore, the financial assistance should be there. It says received more than 10 crore, then this is incorrect. At least 51% shareholding is there. Yes, the Indian promoters, they should have the voting, they should have the shareholding of at least 51 crore or more than that under the Companies Act, and startup working in all these respective areas. So total 15 industries are there. The startup should have worked in those 15 industries, related to those 15 industries, in any one of the industries. 1, 2, 4, and 5. Option A. Yes, now everything is okay. Next, question number 120, sorry, 105. Okay, so this SISFS, this was the for the startups, they can avail the benefit, they can avail the financial assistance by submitting the application. Now this is for incubators. So how the incubators will get the funds from SISFS? So for incubator also, for incubators, they also have to fulfill certain conditions. So incubator must be a legal entity under the society trust under Section 8 of the Companies Act. Yes, the incubator must have been operational for minimum 2 years, means for minimum 2 years, the incubator should have worked in the companies, and the incubator should have the capacity to handle 25 people. Correct. At least five startups must be physically incubated. So when incubator is submitting the application, at that time incubator should have worked in at least a total five startups. At least five startups. It can be more than that, but it should not be less than that. If incubator is not getting any kind of government support, see, normally it is said the incubators should have got the government support. If in case of incubator not got any kind of government support, so the incubator should have been active for minimum 3 years. The incubator should have submitted its financial statement, audited its financial statement for 2 years, and incubated to 10 startup. This condition is only in the case when incubator is not getting any kind of government support. If the incubator is getting government support, then these conditions are not useful to fulfill. And incubators can use third party private funds to distribute seed funding? No. Incubator cannot, like incubator has taken funds from his parents, from his friends, and now this is utilized to provide the seed funding to the startup companies. It is not allowed. Incubator has to arrange a fund from SISFS or from any other source, but they are not allowed to take third party private funds to distribute the seed funding to the startup. So 2 is correct, 3 is correct, 4 is correct, 5 is not correct. 1, 2, 3, and 4. Option A. Yes, so cannot use third party. And it is wrong because maximum allowed government support is 10 million, not more than that. Okay, startups receiving more than that, these are not eligible. So 1 crore or 10 million, both are same. Next, a large Indian manufacturing firm wants to raise rupees 200 crore to build a wind farm. They decide to issue bonds in the London market denominated in Indian rupees. Okay, so Indian company wants to raise how much rupees? 200 crore. And for this, the Indian company has issued the bonds also. Indian company has issued bonds in which market? In foreign market. And what that foreign market is? London was the foreign market. Denominated in which? In Indian rupees. So which instrument are they using? So it's an example of green masala bond. So green masala bond means when Indian company they are issuing green bonds, green securities in Indian currency, in Indian denomination, in foreign country, that is known as green masala bond. Clear? Next, match the data mining techniques with all their description. Classification, clustering, and regression. So classification means classifying the entire data into their homogeneous groups. Homogeneous means into the same nature of the activities are grouped together. Same nature of activities are grouped together. That is known as what? Classification. Classification means summarizing. Then clustering means what? Clustering talks about the predict specific numbers or okay partitions data sets into categories established as part of the process. Clustering is what? We make the data, we make different data are included. Okay, in that numerous of different data are included, and we are choosing one entire cluster for our work. So that is what? That is clustering. So the data are being partitioned, different data are there. These are partitioned into different groups. Groups means into different clusters, and then they are picked for the process. So clustering is the and regression is what? Regression talks about the cause and effect relationship. Like correlate this with the correlation and regression and ABM. Correlation talks about what? How two variables are correlated with each other. And regression talks about that if one variable is changing, if X is changing, how much Y is changing. Or if Y is changing, how much X, how much X will be, what is the value the X will be having. So regression is what? It includes the specific numbers or values it helps in predicting with their cause and effect. One is A, two is C, and three is B. So A, C, B. Hmm. Classification is A. Okay, clustering is C and regression is B. A, C, B. Answer is not A, C, B would be the answer. Hmm. Yes, A, C, B would be the answer. Okay, there is no option given A, C, B. In classification, we make now we summarize all the activities in the same nature. You are saying option A. Okay, just hold this question. Later on, I will check it and I will revert you today itself. Okay, hold on this question. I will check this question once. See, regression is same, regression is B. Okay, I will check classification and clustering. Okay, just hold on this question. I'll let you know in the comment section box in this video only after the session gets over. All right. Next, question number 108. What percentage of outstanding shares of a SPAC are typically committed to voting in support of the SPAC? Just now we have done in the morning session that if the SPAC company is ready to de-SPAC, if the SPAC company is ready to wind up, then the founder shares they have committed that they will always vote in the favor of de-SPAC. Now, what amount of percentage of the outstanding shares they have committed? That is 20%. Option B. Next, question number 109. Statement 1, statement 2, 3. Statement 1, it says velocity. Okay, three V's of big data analytics is velocity, variety, and volume. Velocity talks about the speed of the data, how much one data is transferring to another, in what speed the data is transferring in real time, to the speed at which data is generated and processed. Variety talks about the types of different data. So it is limited to structured data. No, it is not only limited to structured data. We have structured data, unstructured data, semi-structured data. So this is wrong. And volume represents a massive amount of variety, means the type, and volume is what? That is the huge amount of data, means the quantity of data. So data, it is in the form of different like bytes are there, megabytes are there, zettabytes are there. So amount, how much the amount of data is generated in, like, if you want to collect any data, if the data is having too much values, if the data is having in terabytes, zettabytes, gigabytes, so how you will store, where you will store, that is what it talks about. The volume is high quantity of data, high amount of data. Velocity talks about speed, variety talks about the types of data, the variety of data, and volume talks about the quantity of data. 1 and 3 are correct. Option C. Next, 110. Descriptive analytics focuses on summarizing past data to understand what happened. Predictive analytics uses machine learning and statistical models to evaluate future outcomes. And prescriptive analytics explains why a specific trend occurred in the past by focusing on previous performance. So, which one is correct? See, descriptive talks about what happened. Yes, it is written in this line only what happened. It defines by analyzing the historical data, the past data, it tells that what happened in the company. Predictive analytics helps to analyze the future outcomes by using statistical tools and mathematical tools so that one can evaluate their future outcomes. And prescriptive analytic explains why a specific trend occurred in the past by focusing on previous performance. This is what this is all about, the diagnostic analytics, that why it happened. Okay, what was the reason behind it by focusing on previous performance. Prescriptive analytics tells about the recommendations. It gives the ways how we can tackle the future situations. It tells that if the same type of situation, if it arises in future, what are the recommendations, what are the suggestions, what are the activities you will going to do, how you will going to tackle the similar type of situation that you have already faced in past. That is what the prescriptive talks about. So 1 is correct, 2 is correct, 3 is incorrect. 1 and 2. Option A. Alright, so statement 3 refers diagnostic analytics. Prescriptive analytics suggests future action. Recommendations, suggestions. Now 111. Four statements are given. Statement 1, what it says, the redeemable debentures are those which are repaid by the company. Yes, redeemable debentures are what? When company buy back the shares and company repay the amount to the debenture holders, that is redeemable. Irredeemable means when the repayment date is not decided, when company gets liquidate, then only the shares will be redeemed. Correct. Zero coupon debentures are issued at discount. They do not carry any periodic interest rates. Already it is mentioned zero coupon bond means no interest are given, but these debentures they are issued at the discounted price. Like the cost of the debenture is 100 rupees, it is issued at 70 rupees. But if these are issued at 70, so no interest will be given on a regular basis. Correct. Registered debentures are transferable by endorsement and delivery without any need of company's record. See, registered debentures, these are transferable without the endorsement. If the name is already being registered, then these are not transferable, these are not negotiable. Negotiable means what? Like if I'm having the 10 rupees note, okay, 10 rupees note I'm having. If I'm having that 10 rupees note, so that is mine. Okay, I have given that 10 rupees to you. Now that 10 rupees belongs to you. If you will give to the third person, that 10 rupee belongs to that third person. Means the one who is having that document, one who is having that money, that person is the holder of that particular amount. So it is known as the negotiable. Negotiable means that is transferable. It can be easily transferred from one person to another without any kind of further agreement. So already it says registered debentures means the name is registered, then how it can be transferred by mere delivery only? No, it is not transferred by mere delivery. It needs the company records will be checked, then only it will be transferred. This is wrong. Partly convertible debentures allow only a portion of the debenture to be converted into equity shares. Yes, partly convertible means half debentures are converting or a little amount is converting into the equity, not the entire debentures are converting into the equity. So this is also correct. So which of the following statement is incorrect? So one correct, three is incorrect only. Only means E option E is incorrect. Clear? Okay, so these are all the explanation. I'll upload the PDF as soon as the session gets over. So go through all the explanation part. Now, case study on green tech solution. Green tech solution is the startup working on the revolutionary waste management. India-based promoters they own how much 60% of the company. Yes, this condition is fulfilled. In India-based promoters, they need 51% of the share or more than that, but here 60% is this is fulfilled. They recently won a grand challenge prize of only 15 lakh. Is the amount is in the lakh only. It is also fulfilled. They are applying for a patent and want to scale their product to international markets. Now, based on the SISFS guidelines, which statement is correct? They are ineligible because they won price exceeding 10 lakhs. No, this is not correct. They are eligible because India-based promoters own at least 51 of the shares. Yes, India-based promoters, their shares are more than 51%, that is 60%. So that is why they are eligible for the application, submitting the application form to SISFS. Now, 113. So Shell Corporation raised capital through an IPO. Its capital structure consists of the units after the IPO. The shareholding is divided between public and the founder. Okay, Shell Corporation means what? Which company is known as the Shell Corporation? The SPAC company is known as the Shell Corporation. SPAC company is raising funds through an IPO. And its capital structure consists of units. After the IPO, the shareholding is divided between some of the shareholding is divided into the public and founder. How much public is holding? 80% public will hold and 20% the founder shareholders will hold. So if the Shell Corporation raised 100 crore from the public, what is the composition of the unit? So the SPAC shareholders, they get what? They get one unit. In one unit, one common share is there and plus one warrant is there. And warrant will give the right to exercise future future at a fixed price. So warrant holders, they will get the right to exercise their instrument. Right to exercise means if they want, they can sell the instrument. If they want, they can buy the shares of the company at the fixed price. So the price is decided today only, and it will be no matter what the price is in the future. Whatever price is decided today, the warrant holders will exercise in that price only. Like for example, okay, you have got the warrant of the company. For 3 years, you can exercise the warrant for 3 years, and you have purchased. The warrant is given that it gives you the right that you can purchase the shares of the company worth rupees 200. This is the right given to you. If the price of the share of the company after 1 year, if it increases to 400, so even if the share of the company increases to 400, you still have the right that you can buy the share of the company at rupees 200 only. Why? Because of this warrant. This gives you the right. This instrument gives you the right, not obligation. Obligation means what? That mandatorily you have to utilize, you have to exercise the warrant. So in obligation, you will be mandated to use the warrant. That is why only right is given. Right means it entirely depends on your wish. If you want, you can exercise it. If not, then you may not. So that is what the benefit is given, one common share plus one warrant. So shareholding is 80%, all right, and 20% shareholding is 80% public and founder is 20%. Option B. So this is the same. So public investors, they will hold 80% and founder sponsors, they will hold 20% of the share. And one unit equals to one common share plus one warrant. Next, 104, 14 and 115. The government of India established a 10,000 crore dash for startup which is managed by which association? So government of India established a 10,000 crore funds for startups and which is managed by the CIDB. In a de-SPAC transaction, the SPAC must file which form, that is Super 8K form, disclosure with full details. Investors, they have the option that they can redeem their shares. So investors of the SPAC company, they have got two options. One option, either they stay invested in the newly merged company means when the SPAC company is merging with the private company, with the target company, or if they want, they can redeem their shares. They can redeem their shares means they can get the payment back. The company will buy back the shares from the investors and pay the investors back. That is redeem. If they do not wish to stay in the merged company. Google machine learning based search engine algorithm which was the rank brain was the algorithm. It was officially confirmed on October 26, 2015. This is important. Next, under India's green finance policy, the Reserve Bank of India first included small renewable energy sector. Under its see, Reserve Bank of India has said that renewable energy sector would be included, would be counted under the priority sector lending. That is under PSL when in the year 2015. And in 2015 and also joined, this would be 2015, and also joined network for greening the financial system of as a member in April 2021. So 15 PSL 15 April 2021. Next, 118. A climate auditor reviews a company's sustainability report, and that reports all the report notices the company's claims its packaging is 100% eco-friendly. So climate auditor has reviewed a company's sustainability report and notices that the company is claiming that they are making the product 100% eco-friendly product are there, carbon neutral product are there, but in the internal documents after testing, it is being it is being concluded that it still relies heavily on coal-fired plant. So that is not a carbon neutral. It still emitted more and more. It still uses more and more coal and emitted carbon dioxide. So only the packaging material has been changed. The rest everything is same. Now what is that process known as when the company is misleading their customers? When the company is showing inappropriate inappropriate or a company is claiming that their product are very good, it is eco-friendly product, it is organic product. So what is that known? That is the part of green financing. Okay, green financing. So these two are eliminated, green financing. Next is the auditor flags this as a serious ethical violation. The ethics is not followed, and this practice is known as dash and ISO. This practice is known as the greenwashing, and ISO 14,000 addresses it by encouraging transparency, yes, in green finance, and it should prevent all the misleading activities when the company is doing, taking strict action against the companies. So both are correct. So greenwashing and both 1 and 2 are correct. Option B. Next, 119. So state government wants to raise fund to install solar panels on our public school and construct the green parks with rainwater harvesting system. So it issues bonds specifically for these two purpose in the domestic capital market. Domestic capital market and government is raising the funds. So this comes under which type of green bond? That is a municipal green bond. Option C. All right. So all the explanation part is given. Next, 120. A public limited corporate entity is finalizing the issuance parameters of its preference share capital portfolio. So public limited company is checking that whether the company, how much the company has issued the preference share capital. Under Section 55 of the Companies Act, which of the following choices correctly sets for the baseline for the restrictions that are made in the case of exemptions governing these hybrid instruments? So it says that public limited company is finalizing the issuance, that how much preference shares has to be issued under Section 55 Companies Act. Which of the following correctly matches that? What are the things that are not allowed with respect to preference shareholders, and what are the things that are allowed in case of hybrid instrument? So the company is permitted to issue irredeemable preference shares provided they carry a floating rate linked to government bonds with an outer maturity limit of 30 years. C. Under Section 55, it says that the normally companies, they are not allowed to issue irredeemable preference shares for a maximum period of uh, more than the period of 20 years. Maximum they can allow irredeemable, that is 20 years, not beyond that. If they are issuing the irredeemable preference shares more than 20 years, then strict action is taken. But in one case, the company is allowed to issue irredeemable preference shares, and that company is known as infrastructure company. So infrastructure companies are allowed, but apart from that, no other companies are allowed that they can issue irredeemable preference shares for more than 20 years. Okay, 118. See what 118 it says. A climate auditor reviews a company's sustainability. So, a auditor is there, and the climate auditor is reviewing what? The company's sustainability, that whether the company is following the sustainable practices or not, the green financing better or not. And in the report, he notices that the company is claiming that its packaging is 100% eco-friendly. Means whatever packaging the company is doing of the product, the packaging is 100% eco-friendly. It is 100% organic. No harmful preservatives are there. It is carbon neutral means less carbon emission is there. And all these claims the company is making. But when the auditor has checked the internal document, he have found that this company still follows on coal-fired plant. Okay, coal-fired plant means the coal, the biggest reason why CO2 is emitted just because of coal. So coal is the ultimate cause for the emission of harmful emission of CO2 gases in the air. Only the company is heavily relying on the coal-fired plants. Only the company is claiming with the packaging, with the designing, with the color that we are making 100% pure product. So auditor has flagged the serious ethical violation. Auditor has said that this ethics has not followed. The company is working on in an illegal manner. And what is this practice known as? So this is the part of greenwashing. See, greenwashing means you are making your product appear more green than actually they are. They are not that much green. They are not that much, you can say, they are not that much safe, but still you are misleading customers. You are showing your product that no, my product is good from all other competitors' product. So that is the part of greenwashing. And ISO International Standard Organization, these are the standards like 14,000, 14,008, 14,097, 50,001. Just now in the morning we have read, now we have completed that portion. So 14,000 addresses that the these are the standards that follows that if any company is doing any kind of misleading activities, it will prevent that, and it will encourage the transparency in green finance claims. So transparency means if the company is claiming that my product is more green, my product is better than other, so all the disclosures will be done, all the transparency should be checked. That is what it includes. 14,000 includes both of these points. So that is why greenwashing and both 1 and 2 are correct. I hope now it's clear to you. All right. So what it says. So where were we? Yes. So in normal scenario, the companies are not allowed to issue irredeemable preference shares except in case of infrastructure. So it says the company is permitted to issue irredeemable shares and up to a limit of 30 years also. No, incorrect. The issuance of irredeemable preference shares is strictly prohibited. Yes, it is prohibited in companies, and there is a mandatory outer that the limit is set that it should not exceed more than 20 years from the date of issue. Like I have issued the preference shares in the year 2010. So maximum I can issue the irredeemable preference shares that is 10 to 20, 20 to 30. Maximum by 2030. Not beyond that, the company can issue irredeemable preference shares. The company has to redeem it before 2030 only. However, but there is an exemption. Exemption given to whom? It permits a longer period for only infrastructure project. Only infrastructure project are allowed that they can issue irredeemable preference shares to the public more than 20 years, but not for other companies. Only infrastructure projects are allowed. Why? Because infrastructure project a lot of money is stuck. Okay, a lot of time it needs. A lot of people are engaged in this. Company raises a lot of capital for such kind of activity. So that is why company can raise irredeemable for more than 20 years. But in other type of work, it is not allowed. And it is included in section 55. This is the previous year question. Previous year question was asked that what is that section known as? Okay, but the type of question was same. All right. Next, 121. All right, so what the question says an infrastructure firm is structuring a new issue convertible debentures in the Indian debt market to manage their long-term cash inflows. According to the regulatory guidelines, which of the following operational parameters and credit rating requirement must the firm follow? See, the convertible debentures, when company is issuing the convertible debentures, what are convertible debentures? The debentures that can be converted into equity. Yes, this is the meaning of convertible only. So in that case, certain provisions are there. Okay, the SEBI has made different provisions that the fully convertible debentures are allowed. Okay, then if the fully convertible debentures, if their period is more than the 18 months, then they have to mandatorily they have to do the credit rating. If the conversion takes more than 36 months, then two conditions more have to be followed. That is call option, put option. So this portion we have done already. So according to this, which one is the correct statement? Credit ratings are purely optional for all convertible debentures and provided the conversion premiums are set above 50 premiums. So credit ratings, these are not purely optional. If the period is longer than 18 months, then in that case, all the companies they have to do the credit rating. Any conversion timeline that extends beyond 24 months is automatically cancelled by SEBI. Beyond 24 months, see, not it is not cancelled by SEBI. It basically says that if the month ranges from 18 months to 24 months, then in that case the credit rating is allowed. The convertible debentures are allowed. But if it exceeds more than 36 months, it is also allowed. In that case, you have to follow two options, two more conditions. So if the fully convertible debentures have the feature of conversion duration that is longer than 18 months from the date of allotment, then in that case, the credit rating mandatory requirement is there. So option B. All right. Next, question number 122. So what does the question 122 says? What is the primary purpose for the insolvency and bankruptcy code and how does it affect the winding up of the process? See, if the startup companies they are not doing well, okay, they are at the stage of the making losses. They are now in the position of the distressed nature of companies. So in that case, the IBC says that it's better to do the resolution process of this company. So for normal companies, how much is the maximum time period? That is 180 days. Yes, it can extend up to 330 days. This we have seen in ABM paper also. But in case of startup companies, the maximum time period is what? That in that time period, the startup companies they have to close their activity. So the primary purpose of code is to expedite the resolution of insolvency. So yes, IBC code is mainly for the stressed nature of companies to do the resolution process of these companies, and it permits the startup companies to wind up their activity within 90 days. Option B. Now, the Technology Development Fund established by the Ministry of Defense provides benefit under Make in India plan, and it supports different projects which is working for the defense technology defense mechanism. So how much is the project costing up to rupees how much crore subject to maximum funding of 90% of the overall cost of the project. So maximum funding that can be provided for the project is 90% and it is up to how much? 50, 60, 100, 120 crore. So it is up to 50 crore. So this is the cramming portion that we have to learn it. Okay, so to the extent it does not exceed 90% overall cost of the project and it will be considered with cost up to 50 crore. So older it was 10 crore. This you don't have to remember. You have to remember this one 50 crore. Next. Again, the same type of question. What it says, Infracore Limited, an infrastructure company, it is exploring long-term financing options for its 80-year expressway project. So this is the infrastructure company. Again, infrastructure company is there. All right. So infrastructure company is so it means what? What it means that the you can say this the irredeemable preference shares are allowed, yes, for a maximum period of not for a maximum period of 20 years, but even more than that. So they are allowed irredeemable preference shares. So Infracore Limited, it needs money for an 18-year expressway project. So now, instead of issuing new equity shares, which would reduce the existing owner's control. See, in normal scenario, what happens when the company they are issuing the equity shares, they have to dilute the ownership of the existing shareholders. So the board proposes that instead of giving the equity shares, issue issue cumulative redeemable preference shares so that the company may avoid the dilution. Mainly what happens like okay, I'm becoming the shareholder of the company. I have joined the recently a company and I have become the equity shareholder of that company. So if I'm becoming the equity shareholder, now the company has to give me the ownership. Yes, and the ownership is given from which? Ownership is given the other shareholders, they have to dilute their ownership. So what this company said, that the board proposes that instead of giving the equity ownership, so propose that issuing cumulative redeemable preference shares so that they can avoid the dilution. And these shares will be privately placed. They have a fixed dividend rate and these will be redeemable after 18 years. So redeemable after 18 years. So if the company cannot pay a dividend in any year, the unpaid dividend is carried. That is what the cumulative. And the company will return the investors' money after how many years? After 18 years. So investors, they receive a predetermined dividend rate giving the company. These shares will be sold to selected investors rather than the general public. And unlike the loans, the interest is given. Preference dividends cannot be deducted to reduce the taxes. So CFO has reminded that both dividends on preference shares, these are not tax deductible. And the company would not need to seek shareholder votes from the preference shares. So company, they don't need any kind of help. Okay, they normally do not vote on companies matter. However, if their dividend remains unpaid for more than 2 years, they will get the voting right. So the company wants long-term funds without giving up the ownership control. And while investors, they get what? Fixed dividend, they get their money back after 18 years also. So what is the maximum redemption period for preference shares under the Companies Act 2013? What should be the maximum redemption period? It is, remember, it is infrastructure company. So for normal company, the maximum redemption period is 20 years. But for infrastructure company, it can be more than 20 years. But how much it is not defined. So in the question, if you will see, only one answer is that is more than 20 years, that is 30 years. So with your rational mind, with analytical thinking, you can choose the option D because only one answer is given that is more than 20 years. 20 years it is for the normal company, but more than 20 years, 30 years it for the infrastructure company. All right, now next. The same question is there, same case study is there. Next question. Why might infra-core prefer preference shares over equity shares? Why infra-core companies preferring preference shares? So that if the equity shares are given, then the existing shareholders, they have to dilute their ownership. So they help retain control without diluting the equity. That is why the preference shares are given to the investors, not equity shares. So it will retain the control of the ownership. Which one of the following is not a primary approach towards corporate valuation as IVS 105? So there are three different approaches are there. Main income approach, cost approach, market approach. Profit and loss approach is not a kind of valuation method, valuation approach. Next, 127. A data science team is building an AI model for loan default prediction. And in this process, it includes the cleaning the data set, training the model, testing it, and then deploying it. So where we have learned these words, cleaning the data set, okay, removing the errors, removing the duplication, then training the model. Once you have trained the model, then you will test the model. If everything is okay in the model, then you will deploy that model. And we have taken the example of robot that first the model is decided, the data is collected from different sources, then data is gathered, okay, then that data is used for the training purpose, then the training is provided, after training the testing is done, then deployment is done. So it forms a systematic approach, a step-by-step method, step-by-step workflow, and that is the cube flow pipeline. So these are the Kubeflow pipeline. So it helps to automate all the tasks. First is the training is done, testing is done, and then deploying is done. So in this, each and every activity is done automate with following the sequence. Like for example, okay, one analogy is taken, example is taken like you want to bake the cake. So for baking the cake, you will gather different steps. You will collect the ingredients, then you will mix them, then you will bake them, and finally you will decorate them. So simply AI projects, they add in their AI enabled gadgets. These in the same way. First, the data is prepared, that organizing the data, then teach the AI, model training is done, testing is done, and final deployment is done. This is important. The CAIIB and CAIIB comes from Kubernetes, a platform that helps managers and runs the workflow in the systematic manner. Next, 128. An Indian commercial bank reports its total risk-weighted assets how much? 2,000 crore. The bank needs to raise capital via PNCPS. PNCPS, who is allowed to issue PNCPS? The banks are allowed to issue PNCPS. To optimize its capital structure, it decides to issue PNCPS totaling rupees 45. Okay, total PNCPS that is issued how much? 45 crore. And following the regulatory pattern with the Tier 1 and Tier 2 capital frameworks, the bank assumes to meet the minimum capital requirement of risk-weighted assets of 9%, 9% of RWA. Now, how much it is allowed, how much the amount can be used in Tier 1 and Tier 2 capital? See, maximum amount 2,000 crore is there. In Tier 1, what is the limit? The Tier 1, it is 1.5% of RWA. In Tier 2 capital, if extra amount is there, then it will be utilized in Tier 2 capital. It should be less than 2% of RWA. So what is 1.5% of 2,000 crore? 2,000 crore into 1.5. So it is 30 crore. Yes, and what is 2% of 2,000 crore? 2% is 40 crore. Total PNCPS is issued 45. So in Tier 1, how much it can be used in Tier 1? 30 crore. Yes, out of 45 crore, 30 crore can be utilized in Tier 1. 45 crore, no, not 40 crore. 40, uh, okay, I have written correct. Wait. 45 crore, Tier 1 capital 30 crore. So 45 minus 30, how much is left? 15 crore. Now this money can be utilized. Excess money can be used in Tier 2 capital. And in Tier 2, how much the amount came? That is 40 crore. Means 15 crore is less than 40. It means it can be utilized in Tier 2. So 15 crore can be used in Tier 2 capital. So what would be the correct answer? The entire 45 crore is automatically disqualified. No, it is not disqualified. The full 45 crore is included in Tier 1 capital. No, not for full 45 crore. Only 30 crore is included in Tier 1 capital and rest of the amount is included in Tier 2 capital. A maximum of 30 crore can be counted with additional Tier 1 capital. Yes, limited is what? 1.5% of RWA, and in Tier 2 capital less than 2%. And the remaining excess, that is 15 crore, was left, so it will be used, it will be included in Tier 2 capital. So option C. Clear? This P and CPS is very, very important. P and CPS is very, very important. Next, consider the following statements regarding regulatory rules, structural features governing the issue of P and CPS. So the P and CPS, these instruments, they do not have fixed maturity. Yes, they do not include put option. Only one option is allowed, and that is known as the call option. And call option is also allowed when two conditions are fulfilled. One condition is what? The P and CPS, the instrument should have run for at least 5 years. At least 5 years. This is the first condition, and second condition is RBI approval is mandatory. Alright, this is correct. Now, next is bank can issue these instrument with a call option. Yes. And at least 5 years the instrument should have worked, and RBI clearance is important. Foreign institutional investors and NRI can invest up to maximum aggregate limit of 5934. No. Foreign institutional investors can invest up to 49% and NRI can invest. See, this is the total. These are S is there. Foreign institutional investors and NRIs, they can invest up to 24%. And banks are strictly prohibited from granting any advances. Yes, banks are not allowed to grant any kind of advances against the PNCPS. So option Statement 3 is wrong. 1, 2, and 4 are correct. 1, 2, 4, option B. Okay, two more questions are there. Question number 130. Startup India Yatra program, again, it travels in tier 2, tier 3 cities. Incubator Grand Challenge means the incubators are recognized under the Atal Innovation Mission program. So recognizing incubators under AIM. AIM is what? Atal Innovation Mission. Wing is for women entrepreneur, and who provides the fund for women entrepreneurs, entrepreneurship training. The SIDBI provides the funds. And National Startup Awards means for innovative products, or services. The states, they will give rewards in innovation of the products. So national startup rewards rewarding innovation and ecosystem enablers. So we have A is 2, B is 1, C is 3, and D is 4. 2, 1, 3, 4. Option A. Next, question number 131. The Startup India Single-Use Plastic International Challenge, it has been launched with which of the alternatives? Why it was launched? What was the agenda that this was launched? So to help reduce the amount of single-use plastic used in food and beverage industry. Option A. Hmm. All right, and with this we have completed 131 questions and module C. Any doubt to anyone in any of the questions? Okay, so one question was there. I will revert you the question. I will revert the answer in the comment box. Okay, I guess this was the question. Okay, this 107. Let me write it 107. Okay, I'll let you know the answer in the comment section box. All right, so I hope you like the session. If you like the session, please hit the like button, share it with others, and don't forget to subscribe the channel. All right, so all the best to everyone for your exams. See, although you have completed your entire syllabus, but there will be certain questions, okay, round about 5 to 10 questions will be there that will be entirely, you will feel that it is out of the syllabus. Okay, it is out of the box questions. So don't get panicked by looking these questions. Okay, although you have 90-95 questions in your hand, and from that 90-95 questions, you have to bring 55-60 marks. So make the target of 60 plus, then you will achieve the 50 plus target. All right, so don't get panicked by looking all those questions. So all the best. You have done your preparation well, so certainly you will qualify your this ABFM third paper. And do let me know in the comment section box how much marks you have obtained, and also tell me the questions. Okay, so tomorrow we will be doing the paper analysis at 11 a.m. So it is 11 a.m. but collecting questions from different where so it takes 11:15 a.m. So do join the session at 11:15 a.m. So we will be doing the analysis of the paper first shift. Okay. Chalo, so let's meet tomorrow and I will upload the PDF on the Telegram. So make sure you read all the explanation part in whichever question the explanation was given. And one question I'll tell you answer after the session gets over. I'll check it and I'll tell you. Okay. So in about half an hour, I'll tell you the answer. The 107 question. Okay, bye bye everyone. Take good care of yourselves. Let's meet tomorrow. Join the session at 11 p.m. Those are having their exam in second and third shift. So we will be doing the paper and analysis of first shift. Okay, bye bye everyone.